we're looking at here is a specific price model that we're going to cover in great detail during this 8-part video series. And I promise when you're done studying this, you're going to have far greater understanding of price action than any other resource available on the internet or in a book. You're talking about something that is so generic, it's going to be always seen in the marketplace in any time frame, okay? But for real world purposes, okay, for you to study, I want you to use this example here, okay, and start with August 2013, and right now at the time of this recording, it is August 14th, okay, and what I'm looking for is in terms of a repeating theme of what price is doing and how it could be anticipated going in the future. And I also want you to note specific criteria that you see repeating in the way price is moving from one swing point to the next, okay? And what is a swing point? Swing points are like this here. This low with higher lows on either side of it. Here's a low with higher lows on either side of it. Every turning point here, okay? These are all swing points. If you look at every turning point or swing in the marketplace, you can see that that pattern exists. It's very generic. It's there all the time. You have a high with two lower highs surrounding it, okay? Every high and low swinging up, down, that natural ebb and flow in the marketplace is seen with this characteristic in price action. Now, let's go out to an hourly chart, okay? And I want you to study this sample size and data as well, okay? So we're looking at July 1st to, let's say, July 9th, okay? And let's hold down the control key on your mouse, on your keyboard, and hit the letter Y as in the word yes. And that'll give you vertical delineating bars, okay? And what this is doing is the double lines is a Sunday. This is Monday's trading. This is Tuesday's trading in between the two vertical lines. There's Wednesday's, Thursday, and Friday's trading, and then we start a new week on Sunday. I want you to study June 1st to June 5th, okay? In other words, this whole pocket of price action. This right here, okay? So now looking at this sample size and data, okay, the questions I want you to focus on in terms of study is I want you to look at every swing point in this sample size. I also want you to look at the time of day that those turning points occurred. And I want you to look at the direction of which made the most in terms of pips. Obviously you can see it's been in a down move. But what characteristics were synonymous with just about every single one of these turning points? And I promise, if you study it, not just simply on a 1-hour chart, but break it down into a 15-minute chart basis, and if you look at a 5-minute basis, it'll also be more insightful to you as well. So now, again, key points are what time of day every turning point in this sample size and the one we showed before, and what price levels did they occur at, okay? And it means you need to be marking up your chart, drawing lines, okay, and scribble it up, okay? I mean, don't be afraid to put notations on your chart. I don't know why guys, in the beginning of trying to learn, they try to keep their charts clean. When you understand what you're looking for, then it's advisable. I like to keep my charts very clean. But in the beginning, be messy, okay? Make it fun. Get in there and draw some notes on this stuff. And in fact, if you go to, say you have this chart like you have it here, okay, go up to File, okay, and you want to Save As Picture. And you just click Active Workspace, and I'll show you what happens when you do that. By doing that, MT4 will generate a image file of your actual workspace. And by doing that, you'll be able to have a image file that will be in your web browser. And let's move over to that now and you can take a look at what it's done. Okay, you can see it created an image file. Okay, and it's exactly what your chart showed in MT4 platform. Now I'm going to zoom out a little bit, you can see. It gives you all the detail and data here. And you scroll up, you can see everything here. Now, to me, I would advise you to take this image and print it out. Print it out, draw your lines on it with your own hand, with your pencil, ruler, do it like that, okay? And get used to marking up the charts, putting lines and support resistance levels and make notations at time and price. And then I promise you, if you do this every single day for one pair, what you're going to be doing is you're going to be building at least 30 days worth of sample size data. Okay, you want a whole month's worth. Okay, That means you're going to have to actually spend a little bit more than actual one calendar month, okay, because you don't have 30 trading days in a month, okay. So now what you're going to be doing is you're going to be collecting at least 30 sample size of actual trading days, 30 trading days, and I want you to do that with a 5-minute chart, and I want you to do that with a 15-minute chart for every single day going forward for whatever particular period you like to trade. And I want you to mark off every single time the market turns intraday and makes the high or low of the day. I want you to make a reference of what time it does it and what time it ends the opposite end of the range. In other words, what time did it make the high of the day, what time did it make the low of the day. And you need to do this for 30 days. And I promise you, by the time you end with that exercise, you're going to have an immense understanding of price action and what routinely happens in the financial markets.
Okay folks, we are in the second part of the ICT Scout Sniper Field Training Guide, and this episode is going to be dealing with boot camp. Okay, if you remember the last episode, I gave you some homework regarding the first week of July of 2013. Now the screen capture we're looking at here is a 15-minute basis, and we're going to digest a lot of information just in this small sample size of price data. But let's look at the second portion of study we gave as part of your assignment in the previous episode. Now we're looking at a price rally, okay, and in this price swing we're going to be breaking this specific price swing down and how we can utilize generic concepts that go along with every facet of smart money trading. Now again, this is a 15-minute time frame, but we're going to be applying smart money concepts to this time frame that are based on a higher time frame, which is where the institutional level traders and banking traders do the majority of their analysis. Okay folks, we are looking at the Fiber Euro USD. It's the daily chart, and this is the top or the highest point of the price swing that we're going to be analyzing in our first sample size of price action. But I want you to keep your eye on what takes place in price. And as price starts to slide down, you'll start to see a pause in price action here. You see this is the first bullish candle in this down leg. Now if you look to the left over here, you'll see a small little consolidation in here. And you keep going over to the left, you'll see some old highs, a consolidation with some highs and bodies of candles, a short-term high here, and a turning point here, and a turning point here. Prior to that big leg up in price here, okay, this was the lowest low. As price rallied up, it made a high here as well, and then started to move lower in a very large price swing. It came down to a previous level of support. Now the reason why I have this level here is if you look at the body and wicks of all the candles in here, you have the low, the wick here, the wick essentially in here, the top of this candle's wick, this wick here, just tap there just a little bit, again same here, the bodies of the candles here, okay, and if you look at really essentially it's the 127.70 level. And then price when it comes down to that same price point again, the body of the candle stopped here. Granted, the wick of the candle traded through it just a little bit. Then we have the body of the candle here as well, with a small little wick as well. The body of the candle here comes right down to that same level, rallies and trades right through it one more time, and then starts to rally off. Price comes back down, makes this smaller short-term swing lower, okay, and I promise I'm taking you somewhere. I'm just going over the major price reactions and levels that you would be hunting in your future analysis in your demo account trading as you develop as a trader. When price bounced off this level, it came right back down to the same point or consolidation in here, and as price come down to that same price level, notice we failed to get to that same old low or support level 127.70. Price found a new level, consolidated, and moved out of that consolidation and started to trade higher. Now this price swing in here, okay, is the basis of this price rally here. Now as price starts to move lower, we would be looking for areas where we would reasonably expect to see price to stall. Price bounced here. Now just for illustrative purposes, let's just use the very low of the wick here. And I'm just going to double check the candle, make sure I am indeed on the low. The low is 130.58. And we're going to move our level right to that point. And you can see this swing high. Remember we talked about in the first episode, a swing high is a high that has a lower high on either side of it. Okay. We have a nice level of support resistance in here. Same thing here. Nice support resistance. Nice support resistance. Nice support resistance. Again, same here. Okay, we have a nice swing high as well. So this price point, while it is an off even number, it could be very easily calibrated to 130.60 level, okay, which I think is a much more reasonable level to move this line to. And what that means is the institutions like to use large round numbers. They're not so finicky in terms of trying to get like the 8s and the 4s and the 3s and such in terms of filling. They'll just use the round numbers to get their orders off on. And I'm just going to key that in here manually so you can see. So I'm using 130.60 as a round number. You see it gets right to that high here as well. And again, it doesn't really essentially change too much over here, but when we get down to a smaller time frame, it might be more useful to us as we see the levels more closely calibrated to a smaller round number. Now when price gives a bullish candle here, this by itself indicates a lot of different things. And this episode will not be long enough to go into the information that these types of candles create, but I promise we're going to delve into those things in later episodes. But for now, we're going to be giving a lot of generic, broad ideas about how smart money operates in the marketplace and how you can more or less follow their coattails and try to hopefully see a profitable swing in your favor. Now as price continues to move lower, okay, this same bullish candle, okay, when we cause this bounce in here, something about this level at 130.60 was a catalyst. Okay, now institutional level trading, again, revolves around round numbers. So a lot of questions I get through email, and if I'm haunting a particular forum or such, they will invariably ask me, hey, ICT, can we get a little bit more understanding of how it is that you arrive at what would be considered your key support resistance levels? And what do you mean by institutional levels when you say price is going to come down to this institutional level, or you expect to see a particular level swept? Okay, I'm going to cover that in this module so that way you have a greater understanding. So that way not only will you understand my videos when I do reviews and trade recaps, what I'm referring to, but you're also going to see how to look for it in your own charts. And you'll understand what it is specifically that price action is doing and why. So price bounces here, okay, at an old swing high. Bounces here. Now, price trades through it, but if price ever comes back at that same level, that is a potential area of a setup. Okay, so we could look for a selling opportunity should price get to that same level again in the future. And you can see price trades right up to this level here. The high of this candle comes right in at 130.59. So we fell 1 pip short of the actual round number, but you'll see when we go down to a smaller time frame, it really doesn't make that much of a difference because there's a lot of other factors that will be more beneficial to us. So now we have the next candle here. It sweeps up through it and then trades lower and closes on almost below the candle. Price trades right back up into a bullish candle here, right into our 130.60. Now the high again on this candle comes in at 130.73, so we're 13 pips off. So again, we're looking at a daily chart. So if we're going to be just off by 13 pips and we're looking at the daily ranges, again, these are all full daily bars. That's not bad in terms of highlighting areas of potential setups or bounces, and that's what your framework is going to build upon this. So again, we have that 130.60 level in here. Okay, this daily candle trades up into it, squeeze through about 13 pips, and then the next candle we have a very nice reaction here, trading lower. Now again, all we're looking at is how price is moving on the daily chart. So as we see price moving lower, we just keyed off of a nice price level here. Now as price is trading lower, now where would we reasonably expect price to trade back down to if it continues at all? Because there's no guarantee that price is going to continue lower, but because we have seen price trade off such a nice move lower, we broke through old highs. So now where we're going to be looking for old lows, they are found here. And if price trades through that, where do we go next? These lows. And if price was to trade through these, where would we go next? These lows. Okay, and that's what you're looking for. Again, a consistently highly successful trader does majority of his analysis on the higher time frames. So who is it that moves price? Who can take price from these levels here all the way down here? They are the large dominant players, or what is commonly referred to as the smart money. Same entity takes price from these levels up to here, and vice versa from this high down to this low, and this low to these highs, this high down to these lows. So the question begs is this: if you're not spending time trying to learn what it is that they do, okay, on a larger time frames, aren't you really shooting in the dark? I mean, you're really not giving yourself any real measurable chance. You're stacking the odds against yourself if you're looking at time frames less than 60 minutes all the time. Roll your sleeves up, get yourself some time in front of the charts, and spend some study. Not looking for trades. You want to be studying what price has done in the past, why it's behaved that way, and I promise you will activate your reticular activating system, where it basically tells you every time you see something that you've grown accustomed to seeing, your brain will immediately allow that to come into your mind, and you'll receive it, and you'll say, okay, the last time I saw this happen, this is what transpired as a later effect. If you don't first train your mind to see what it is that price has done in the past, and it repeats over and over and over again, invariably you're going to be a better trader because of it. And I promise if you spend some time with it, you're going to see some value in it. So we have this 130.60 level in here, okay, and price starts to trade off. And as price moves lower, again, we're eyeballing these levels in here. Now, as price starts to move into these lows, we could reasonably expect to see pauses, bounces, but you can see there's a very large acceleration moving lower. Price gets a small little bounce in here, this little bullish candle, okay, and that's on the heels of these lows here, okay? But price eventually trades all the way down right into this 127.70 level, again, which is that level we have over here, and these lows here, and you can see how price reacts there. Now, there really isn't any magic to this. It's simply understanding what the institutions have done in the past at that particular level, and when price comes back down to it, we anticipate the same reaction or similar reaction in deference to what price is going to do next. We don't have a crystal ball. We don't know for sure what's going to happen. There's no guarantee that it's going to always transpire like this. So that's why we use stop loss orders, and we use sound, prudent risk management models, where it gives us a shield. Okay, we're not expecting perfection. We're not expecting to know every single swing in the marketplace. We're not expecting to not be stopped out in trades. We're expecting to be more consistently positive than negative, and permitting ourselves to have that occasional and maybe even string of incorrect, I'll use that term for now because I don't want to talk in terms of profitability yet, in terms of correctness in our analysis. Okay, that's where you want to be focused on now. You want to be looking at, are you doing the same thing consistently over and over and over again with a large sample size of data that supports this theory. Okay, and we're going to give you a whole lot of things to look at that you can study on your own, because I'll ask you this also. If you're new to trading and you have your charts open, maybe you're at work, or maybe you come home from work and it's, you know, over the table, dinner table, you got your laptop or iPad or whatever it is that you may be using to look at charts, and you're looking at these price charts and you're staring at it like a deer in headlights, trying to figure out what it is that you should be seeing. A lot of that fog is going to be lifted. Okay, it won't be completely eradicated, but it's going to be lifted in this episode. Okay, so you can clearly see just by this simple approach of looking at the higher time frame charts here. Look at the nice price moves here from this same level we just highlighted here. Okay, if we look in terms of pips, now again, we're not expecting to get the entire move, guys, so please don't build that as an expectation on your part. But if you look at that move from that level down to this level, that's 292 pips, and that's pretty respectable. Now again, these are all daily candles, so it's less than a month. So if you break that down, it's pretty, it's a pretty good month. But moving ahead, you can see price does have a very, very aggressive move higher, and then we start to consolidate. Look at the wicks. Okay, see the wicks? They're all stabbing through that 30-60 level, but the bodies are having a hard time making any measurable move lower. You see that? Now watch what happens. This same level now, okay, becomes an inversion level where it was support here, it inverts, now it's changed its role, and now it acts as resistance. And as price comes right through it again here, now we're on the northern side of it again, so now it resumes its role of what? Support. Okay, so this tells you that the institutions are doing some pretty significant dealings around this level here. Okay, so as price moves away from it here, And if you see any kind of type of retracement here, this is when you can start to hunt a buying opportunity, because now we can trust with a certain measure of expectation that this is now going to potentially hold price above that 130.60 level. The price rally up here, this level here becomes sensitive because this old low here, which is these old highs here. Okay, so again, we're looking and studying, not just, okay, well, I'm going to grab this high and this low. And if you just look at these highs, and look, it's this low and this high, until price gets to these levels, that's a long time you're waiting for. You're not going to be doing a whole lot of trading. So what are you going to do? You're going to chase systems. You're going to chase something that, is more active. Okay, and that's problematic for a new trader, because it's not about how many trades you take, it's the quality of the trades that you take. Okay, so now when price moves away from this level here, we can start looking for other specific price points that will aid us in support resistance. Now, these old highs here, price trades right up into them again, okay, and then trades off. Now, again, it's not about capturing every single major high and low. You just want trading opportunities. Just in this price swing here is 191 pips. Just this, 191 pips, and we're talking about a week's worth of trading. And then price does what? It snaps off again. What did this rally take action off of? See this high here? See this swing low in here? You have a lot of body candles, and then boom, right here. And you see price rally up. Price punches through this high and this high and gives us a reaction here, and then trades back into this candle as well. We're going to be looking at two sections of this market, and we're going to be looking at this move here, and we're going to be looking at this move down here. So we're going to be looking at trending environment, which is what this is here, and a potential reversal area. And we're going to be looking at this specific price sample here. And it's a little bit different characteristic of this that will not be so notable here. This area here, as you can see. Now, the first episode I talked about looking at the 1st of July to about the 9th of July, okay? And I wanted you to study what price was doing in all of this sample size of data. Now, again, we were talking about that section. This is where price was moving down, trading lower, lower, lower aggressively, again, off that 130.60 level that we noted. And again, I'm just going to add that level back here so you can see it. Okay, and this is that daily move where it trades right up into it and then had a bearish move lower. Okay, and then we started to move lower and lower and lower. Because we study the higher time frame, we can discern where the institutions and large traders are more apt to muscle, if you will, the price of a particular market one direction or the other. You as a retail trader, me as a retail trader, I can't move the market. I have to rely on the entities that are large enough that their orders and their buying and selling pull price out of the current status that it's at right now. For instance, when price was trading around that 130.60 level in here, when it's trading here, large institutions come in and they put big orders through, okay? But they don't put all of their orders in at one time. They have to work that order in, because they're not like you and I where we're hoping to trade, 100,000 of euro, okay? They're not worrying about making $10 a pip. They're moving massive blocks of price orders that hopefully can be filled before price starts to move away. So as price moves into these levels, they're putting small pieces in at a time, okay? Why do they do that? What is it specifically that they're trying to avoid? Much like anybody else, they want to get a good price. But because they're smart money and they're on an institutional level, they are huge, okay? For instance, let's take a step back conceptually. Looking at the market, okay, the Forex market, you'll end up as a new trader, okay, we have a very childlike perspective of this is like a video game, or this is an adventure, okay, or this is going to be very fun. This is going to be my new hobby. And we'll stick with the childlike theme. Okay, so this represents Forex. Looks inviting, doesn't it? You just want to jump in there and have a splash. But we're going to use this analogy, this small little pool here, that will represent the market. Okay, the arena is the pool, okay, and price is the water. We can get in that pool and we can make little splashes around, okay, as retail. But that water will not be displaced by retail traders. We'll make small little minor little blips, okay, like you see here, okay? But when smart money gets involved, okay, they're like that elephant in the room. You can't really hide him. He's standing right there in front of you. Okay, imagine if that same elephant now decides it wants to join the pool party. What are you going to have? You're going to have a large displacement of water. They cannot hide it, okay? They are invariably going to be noticed if you understand their footprints, okay? As price trades up to this level, at 130.60 level, it's trading off. It trades through it again, and then trades off. It trades through it again, and then trades off. See, this is the first telltale sign that somebody on the big level, okay, we don't need to know who specifically, but we just know that somebody on a larger perspective is now getting involved with this market. And what are they doing? They're shorting, okay? They're becoming sellers. At a level now that we discerned on the daily chart that this is probably going to be an area that's sensitive. And price comes up, stops right on a dime here, then trades off a little bit. Now, what's happening is they'll put orders in, they'll sell a little bit, and sell a little bit, and sell. And eventually, when they know they can put their last bit of, their trade on, okay, they will, just stack their orders all in this level. And it may be a little bit above it, a little bit below it, but they're generally trying to get an average price around that 130.60 level, okay? It may be that 130.50 level as well, because it's a half of a full figure, mid-figure level. So that may be the price level they're actually working to. But as price moves above, okay, you can see how every time it does this around that level, look at this whole price action in here. You can see that this is a failure to run above this old high, okay? Now when we see price trade off, I guess, and it fills in all of that price decline like it does here, okay, this is smart money trying to get that same price action. They put a large block on here. Now their liquidity is limited to whatever's there at the time. So if there isn't a large pool of buyers here, okay, there will be a issue for them to get the rest of their orders off. So what they'll do is they'll put small, and again, to us it would be large, but to them it's small blocks to get their overall average price of their net short position that they want to be establishing. Once it's established, okay, price will do what? Drop, because there will not be any more buyers for the other side of their trade. Okay, there's no more buyers. So what's going to happen is it's going to create a heaviness in the marketplace. So now the net selling will take a larger toll on price action. And as price starts to trade back down, every little rally in here, okay, will be new selling opportunities. Now, many times you'll see traders see these rallies here and they'll chase that. How many times have you done that? See this type of thing here. Look at this, man, it's rallying up. I better chase it. Let me buy this because it's probably going to go through these levels here. It's going to go through these levels. It's probably going to keep on going, and maybe we'll see 130, 150, or whatever else the guy in the forums or on the internet was talking about how it's going to go there because their cool little indicator said so. It has nothing to do with any of that, okay? If you start looking at how price is now moving lower, okay, you can see they're rapidly moving price to a specific price point. Where? Remember that 127.70 level on the daily chart that we looked at? Let's put that in right here. Now, the first decline here and trades right back up into this level. Note that this price drop takes out a major, well not major, but a significant swing here as we trade into that level. Now again, the main focal point is the higher time frame key level, that 130.60 level, okay? We don't go to the lower time frames hunting a pattern or a signal or a setup and then try to find a level that supports that notion. That's not how we're doing this, okay? You start on the higher time frame chart and you find key levels, okay, that are obvious. Because if they're obvious, that means it takes all the guesswork out. Now it may take some patience on your part. That dreaded word P, patience. The long and short of this is you're going to need to exercise a whole lot of patience because until price gets to these higher time frame key levels, you aren't going to see institutional sponsorship behind the moves, okay, unless you find a move like we're describing here, where we have a level noted on a higher time frame and another level based on that same time frame that is a higher level support level. So between these two levels here, we don't have a whole lot in terms of higher time frame support lines that would really expect to see price turn around on a dime, okay? Now, we do have intermediate term swing lows here, okay? and we have short-term swing lows here that cause pauses in the marketplace, okay? But we're not focusing on the short term. We're trying to train our eye to see the intermediate term price swings, okay? So now let's take a closer look as to what's taking place in here. We're going to introduce the time of day, and what we're going to do is we're just going to highlight with some arrows, okay? We're going to look at specific little areas where price made significant price highs and lows. Okay, and what I'm doing is, because on the higher time frame we had already established a bearish tone to the market. In other words, we were expecting this level to be sensitive and that we would expect to see price moving lower. Okay, and where would it be moving lower towards? This level down here, because it would be the next higher level time frame support level. So we have a whole lot of range to work between. Okay, and this gets to the central tenet of directional bias, because a lot of traders, it just escapes them, and it's simply because they're expecting it to be, again, real easy to determine, because just look at the chart. Well, you have to go and spend some time on a higher time frame, because that's where it's going to tell you. So we have a range of 291 pips between the high here and the low here, these two higher time frame levels. So 290 pips. Now watch what happens. We're going to be looking at things that are generically repeating. Okay, so we're going to introduce also support and resistance, but before we do that, we have to break our chart down into time and day of the week. Now the double lines represent Sunday, so this vertical line to this vertical line represents trading for that week on a Monday. From this vertical line to this vertical line represents Tuesday. This vertical line to this vertical line is Wednesday, and this is Thursday's trading, and then Friday, then we go into a new week on Sunday. On your notepad, write this very, very big, okay, and underline it. In bearish market environments, okay, what I mean by bearish market environments, if the daily chart is poised to move lower, you have a 70% chance of seeing the high of the week form by Tuesday's London Open. Okay, so if you have a bearish expectation in the marketplace, expect the high of the week to form by Tuesday's London Open. Now, sometimes you may get that weird, crazy move that will take out Tuesday's high with Wednesday, and that may be because of a major market moving indicator or report that comes out. And that's going to be that one wild card event where, sure, you may have been in a profitable trade, and if you didn't take any profits as you went down going into Wednesday's trading, before it trades and runs your stop or runs you out of your position, they're going to happen. And I have not been able to find a way to avoid those types of things. Okay, but by far and large, if you look at when markets are trading softer and moving lower based on the higher time frame, again, we're specifically dealing with the daily chart here. Okay, but you can also move down to the 4-hour, but really only if it's really not clear to you on the daily. So again, the daily or the 4-hour, that's where your higher time frame key support and resistance and bias is determined from, because we're looking at these higher level time frame support and resistance levels that the institutional traders are going to be keying off of. Okay, so again, with the notion that this market is moving lower, okay, we would reasonably expect to see the high of the week form on Tuesday's London Open or Wednesday's London Open at the very latest. Okay, we see the high form for this week on Tuesday. Okay, and as price trades up to that point, it's coming off of this low here. Okay, so we have this low as a reference point, and it'd be nice if I would kept that on the low before it was drug away. Let's put that back where it belongs. Okay, and what we're going to do is we're going to draw this all the way through the week. Okay, because this level is sensitive, because it's a nice swing low going into a key level and then traded off. Even this little bounce in here is tradable, but we are focused on being what? A seller. Because of what? The premise is that we have seen price trade up to this 130.60 level in the daily chart, as we discussed earlier in this episode. And as price trades down and it starts to have these bounces, we do not get all excited and frothing at the mouth thinking that, okay, now it's going to trade higher and we want to be a buyer. Okay, think classic chart patterns. Does this not look like a bull flag? Okay, price rallies up, consolidates, and it's even doing what? Finding old support. See here? See the support? See the support? And what do they teach us in the textbook? 3 points of contact confirms the support level, right? You don't think the dealers know that stuff? They know what you're going to do. They're going to hold price here, okay, and then allow what? Orders to stack up. What kind of orders are going to stack up? Buying orders. Who's buying? Retail, the less informed traders, okay? Well, if they're buying it, who's providing the other side of the trade? The smart money. What? Yep, the smart money. They're selling it to them, lock, stock, and barrel, okay? Who's going to win in that arm wrestling match? The elephant or the child? The little kid in the swimming pool? It's going to be the elephant. When the elephant gets in that pool, boom, the kid is taken completely out and the water is displaced. So what do we see? Displacement, okay? Price is now taken, driven lower, okay? Those that would have been trading what would be whatever their idea of this is a climax reversal or something along the lines that would support a buying indication in here. And again, we're not arguing or making any case for that, but we're just going to assume for a moment that somebody out there in the retail world assumed that that level was probably a good area to buy. So if they bought here, where would their stop loss be? Right below that. Okay, so price is driven where? To where the liquidity is going to be, here. Okay, so here we're going to have price trade down and trade right back up to what? This level. Now it becomes another selling opportunity. Who's going to sell? Some more of the smart money. So they're going to put some more of their orders in, and then boom, it rides lower. Okay, this short-term swing low here, because we're not drawing levels on it, okay, you can look at a lower 5-minute chart and see even greater dynamic support resistance levels, but I'm using a 15-minute chart simply because you'll learn later on that your trade setup's really going to form on this time frame. But we're going to keep it uniform and keep the continuity going, and we're going to use this low here, price trades up to there, and once we blow through it, we trade through it again, okay, but we come right back up to this old swing low here. So I could have another level, but to keep it clean on the chart, I'm just going to keep it, just like you have here. Don't expect, perfection in terms of your support resistance levels. Sometimes they'll knock your socks off and be so specifically, right to the minute on the pip. But we're only talking about here 14 pips in terms of variance. So again, that's less than half of what my normal stop loss is. Again, for those who don't know, I usually trade around with a 30 pip stop loss. And again, we'll understand later on why I use that later on. Again, not now. So we move into a new week, okay? Price rallies up, and this little pause here and turn down happens where? Look over here. See that? Okay, so price trades down. Okay, find some short-term support, which we're not going to look at because it's going to be on the 5-minute chart. You can do that on your own. It rallies through, okay, and does what? Blows out a swing high. Why? Because maybe at this point, some guys have figured out this is in a down move, okay? So they're going to be doing what? They're going to be selling. Yeah, those guys sometimes in the street, okay, get it right. But do you think the elephant really wants them in the pool with them? No. Okay, so what's going to happen? Well, they're going to be short, okay, and they're going to use this old high as a level to do what? Protect their position, right? Even if they're selling down here, or maybe they sell this low here and they want to be a seller right there, great. What are they going to use as their stop loss? It could be this high here or this one. So let's take a look at what happens. Here's your old high, and we're going to use that level, and we're going to just go above it a few pips, not much. Here you go. When price trades right there, the nature of the spread does its work right there. What order would be resting here? Again, assuming that the retail traders are short. There's going to be a buy stop right here, a buy stop. So when that price trades up and boop, stabs into that level here, what's going to happen to that buy stop? It becomes a market order to do what? Buy. Who's going to sell it to them? Smart money. And then when you see price rally up like that, bang, what do? They drive it down to their level. Okay? And now this is where they liquidate all their short positions back here. Now they could have liquidated some in here. Okay, and that's what caused the pause in here, because now they're buying back some of their net short position that they've assumed between the 130.60 and 150 level up here in this block of price action. But as price trades down to this level here, okay, they're essentially now no longer heavily net short. They may have some shorts still on, but essentially they have been unloading every time price dropped lower, okay? Because they're larger institutional traders, they have to be exiting during the move, but certainly driving price down to a specific price point, as we noted on the higher time frame. Now, when price gets to these levels here, we could look for patterns to trade, because again, this would be a higher level support level, okay? And then you can see price does indeed rally up. Okay, and for those that had been using these points here, okay, and trade on a daily time frame, because there are 9 to 5 desk jockeys and they can't be in intraday traders, so you use daily bars to put their stop loss orders. Okay, those guys are crushed as well and left feeling bewildered and like the game is rigged. And you just learned that it is, in fact, it is rigged, and there's a means of understanding how it's rigged. Okay, let's look at these specific times when price moved. Okay, this high here takes place at 1445 GMT, or 1500 rather, 1500 GMT. This high here takes place at 1500 GMT. This high here is essentially 2330 GMT. And this high here is 11 GMT. This high here is 12 GMT, and the high here is 6:30 GMT. That's early New York. I'm sorry, early London Open or Frankfurt. This is New York Open. This is the very beginning of New York Open. This is Asia. This is London Close. And this is London Close as well. So you can see there are specific turning points that are occurring at session open and closings. Let's look at the notion of fractals in price action, and we're going to move over to our second portion of price action and study this segment of price. Okay, this is the second portion of price that I was asking you guys to study. And what I have here is I have the price levels on a 15-minute basis, because remember, we talked about how price is universally limited to trading within support and resistance levels, but each time frame has its own support and resistance levels created as price gyrates up and down. What I did here, and this is certainly not every single one of them, but what I want to draw out with your eye is I want you to see there's a specific overall price structure here. Okay, now this concept is not going to be fully explained and understood by watching this one video, but if you spend time in the charts yourself, you'll start seeing these things repeat over and over and over again. And it's one of those things you have to keep looking at it before your eye gets accustomed to seeing it, and then right away your brain will do the magic, okay, of seeing it, remembering, oh yeah, this is what this is, and then boom, you'll know naturally what you should be doing. And that, again, I'm not talking about trading with your gut, okay, this is what you do with your eye, okay, you're trading what you see. Price trades off of a level of support, okay, and we're just going to assume that the 132 figure was significant enough to provide support, and price rallies off here, okay. Price comes back down, trades down into that 130 to 30 level, essentially, okay, and bounces and runs through and creates a short-term support level, okay. Now price has since been trading higher from that low we discussed when price came down in our previous example on the higher time frame where we found that support level. Now as price moved higher, okay, you can see this stair-stepping environment that you can see price doing, and eventually it reaches a level of resistance. Now we're going to show why it's a facade on your part to look at these lower time frames and expect with any reasonable consistency to be able to see what's going to transpire next without having any idea of what the higher time frames are doing. Now on a short-term level, okay, short-term basis rather, with the higher time frame premise in mind, until a higher time frame barrier is met, and this is going to be in the form of resistance, okay, and that would be seen up here, which we'll look at in a moment. Until that is met, that barrier or that obstruction to higher prices, one could capture trading opportunities when price is finding support, okay. Again, we're looking at the first week of August, okay, the first week of August, and again, we're assuming, again, that the market is still bullish, so we'll be looking for the low of the week, okay. Now we reverse the script we learned earlier about the trading day of the week. For down moves, we expect to see the high of the week formed by Tuesday's London Open, or Monday, and the very latest by Wednesday's London Open. But 70% of the time, you see the high form on Tuesday, or the low form on Tuesday. In this case, the low of the week, okay, because here's the end of it, here's Friday's close, here's Monday's open. The market opens on Monday, trades lower. This is the low of the week, okay? Write this on your notepad. When there is a large range bar, okay, whether it be a daily or 4 hour or 1 hour or 15 minute, it really doesn't make a difference as to what time frame it is, but whenever you have a large bar or a large candle, large candles on any time frame do not usually work both sides of the opening of that candle very much, okay? And what do I mean by that? Well, we're going to use this example here. The market opened on Monday on this particular week. It trades up a little bit, but we're not talking about very much here, okay? Let's look at exactly what we're looking at here. It's moves up 25 pips. It moves down 42 pips, okay? So it starts off going up about 20, goes down about 40, and then starts to move higher. But notice it doesn't work both sides of the opening very much. If we're bullish, we can reasonably expect to see any decline be very modest, okay? So we could be a buyer on weakness with the understanding or level of confidence that if this is a bullish week and it trades lower, okay, on Monday or Tuesday, we could be a buyer if it finds support, okay? But now prior to this price drop, I'm going to ask you, what do you see here? Now we're looking at the 132.30 level here, but again, because we moved down to a lower time frame, what other level stands out? You see this high here, the short-term high? Let's note that. Now I will admit it's not very much in terms of difference between here and here. Okay, this level, let's note it so you can see what it is. It's the 132.26, and this is the 132.30 level. So it's not much in terms of pips, but if this was an hourly chart or a 4-hour chart, this could very easily be 50, 60 different, any number of pips that's greater than this, less than 10 here. So again, I'm trying to take your eye and train it on a conceptual basis and not limit it to a specific time frame, okay? The things that are generically inherent or sensitive to time frame is the higher time frame, the daily, 4-hour, and 1 hour. So the trend, the directional bias, the high level support resistance levels, those things don't move. They're very, very, very powerful. They're static. You have to directly relate them to the higher time frame. Again, daily, 4-hour, and 1 hour. No trade whatsoever. You should never take a trade outside of having a key support level or resistance level that is either from the 60-minute minimum, 4-hour, or daily chart. Okay? If you do this, your trading is going to move to another level immediately. But it's also going to force patience, which is a very hard characteristic for traders, especially as a new trader. You're not going to have that level of patience, okay? But by applying the higher time frame support resistance levels, it's going to force you to wait, and that's a good thing, because that's a characteristic of good trading that has a learned characteristic. So now looking at this price action here, okay, we have this short-term high here, okay, we have these swing lows in here, okay. So what in this block of price, what level in here is being worked? Any idea? The 132 big figure, okay? 132 big figure. So what we'll do is, let's move this down. Okay, and what I'll do is I'll take this level, and I'm just going to put that here. Okay, so we have a price level that's being worked here, and we have a very short-term high here as well, but this retracement here, okay, you see that? We're going to introduce briefly, I don't want to do too much of this because I can very easily turn this into a 4-hour teaching just on fibs and won't even scratch the surface on what's applicable with it. If you pull a fib from that level, okay, this is the support level, okay, we have price here rallying up away from it, making this high here. Okay, you see that? Do you see now, let me put this right on the level because I want to be consistent about what I'm showing you. This is the 70.5 level, this is the 79% level, and this is the 62% level. Price comes down to 62 and bounces. And then what does it do? It rallies off. Trades up into old lows, old high, resistance, into Tuesday. Okay, Tuesday trades down. It makes a low. the low here comes at 6:30 GMT. Think in time of day. That's middle of Frankfurt, the very early stages of London Open. Okay, just go back here for a second. The low on this day here forms at 13:45 GMT. The high of that day, on Monday, forms at 7:45, which is London Open. So now we have another minor move here in retracement. Okay, if you pull a fib from that price swing from here to here, and I'm going to take this one off so you can see price comes right down to that 62% retracement level. Now we're hunting or stalking buying opportunities. Okay, but the 62%, what else could we use? Okay, well, let's see what else happens around that 62%. We have the 132.47. So isn't that really the 132.50 level? It's a big round number, right? So you can see price comes down to that mid-figure level and then bounces. So there's a confluence of support like that. Okay, now price rallies up, comes down, bounces here, trades up, finds a high, and then retraces to do what? Well, this old high here, once it's broken through, it becomes an inversion level again. It's resistance here. Once broken, okay, its roll is inverted, now it becomes a support. Rallies off, okay, and then comes back down on the very next day. So you don't have to rush. If you miss this move, fine. Then you start seeing on Wednesday, price retraces, okay, and you would do what? Expect it to find support where? Here. But now watch what happens. You take your fib and the previous day's low, pull it up to the high. This is the highest point from this low to this high as it retraces. Do you see what it's done here? Here's the 62% retracement, the 79% retracement level. We have a confluence of support and resistance on that 70.5 level or sweet spot. Okay, this is like that target crosshair on a sniper scope. This is exactly what you're looking for. The very low of this candle, okay, comes at exactly at 9 GMT. That is the London Open kill zone. Price rallies up, takes off. Okay, breaks through this old high. Okay, see that old high here? Breaks through that. Let's take our fib that we had drawn here off. Okay, price rallies through it and comes back and does what? Finds an inversion level. This resistance broken. The roll is inverted. Boom, it becomes what? Now support. Okay. Now I'm going to refrain from breaking down to a 5-minute chart just to show you the optimal trade entry here. But you see this swing low here? This is London close. This little swing low here. This occurs at London close. Write this down on your notepad. Every session high and low. In other words, the highest high and the lowest low it makes during each session. Okay. That means the London session, the New York session, the Asian session. Okay. I only look at those 3 major trading sessions, and you want to be looking for the highest high and the lowest low. And it's easiest to do that research on a 5-minute basis. Okay. And you want to be getting used to seeing what those ranges are for those individual sessions. Now, when you use that information, you'll be able to pull your fibs from these particular price points, and you'll see the signals that evade many people. And a lot of times people watch my video and say, well, it looks like hindsight to me. You'll see that this is the same stuff applied over and over again. Okay, so we have a low here, which is old highs here on Tuesday. So these are all lower level support levels. They're now dynamic. So this level is good, but you can fine tune it also. Okay, but more importantly, as price trades back down to this level here, I'm going to show you. This is the high and the low, and here's the 79% retracement level lying right on top of this support level. So we have real support resistance with overlapping Fibonacci, 79% retracement level with a directional bias in mind, looking for higher prices. Okay, so you could be a buyer on this candle here, and this candle comes in at 2:45 GMT. So you guys that work all day, you could have been a participant on this move. This is an Asia session trade. Price moves up, blows through a short-term high that it creates on this day here, and meets a otherwise unknown resistance level. Okay, do you see the facade here? If you're just looking at these types of charts, 15-minute basis, if you're looking at sub 60 minutes, anything less than 60 minutes, without having a reference point on the higher time frame, you really are throwing darts in the dark. You have no idea what you're aiming for. Okay, you may think you know what you're doing because the price is trading up, and maybe you're drawing trend lines and all that business. Look, if you don't have the higher time frame premise in mind, you are gambling. There's no other way of saying it. You're just simply gambling. So now we're going to look in a moment at what this catalyst was. Okay, and it's going to be very clear to you. It won't be like, oh, this is hindsight picking it. You're going to see it's so clearly obvious why it turned here. But eventually price does break down and trades down, breaking all of the higher highs, higher lows, high, and it's all broken here. This low is broken here. So now we have a break in market structure that we're going to learn more about in later modules. But as price breaks down, okay, this support level, as we see my little bounce here, price comes down, breaks through it, and trades right back to it now. Okay, so now if you pull a fib from this high to this low, you can start seeing overlapping, and you can do this on your own chart. Because this video is getting very long. You can see there's this selling opportunity. The candle here comes in at 6 GMT. This is Frankfurt opening, the very beginning of Frankfurt. Price trades down, finds some support. Okay, if you just look over here, where price starts to take off in here, this little pause or consolidation, it bounces right at that same point. Comes up and starts making a larger range, okay, and creates a tap to this old swing low is resistance, and then trades lower and breaks through this swing low, trades softer, right back down to old lows that I did not have loaded on the chart as a horizontal line. It bounces, trades up to a known level of resistance, okay, and comes back down and starts consolidating. But it's consolidating around that 132.50 level. So that's just calibrate our level here. Okay, we're going to leave that there. And I'm going to take this one off just so it won't be confusing to us when we go out to a higher time frame chart, because I want to illustrate what it is that's transpiring here. And now up here, if you look over here on the left, on the right hand side, this is essentially the 134 figure. So what we're going to do is we're just going to highlight the 134. Okay, and it was 133.98 was the high that day. But we're going to see there's an actual high on the higher time frame that this would have been utilized as a reasonable expectation. Expect price to be either pausing at that level or maybe a little bit above it, excuse me, or below as we have here. Now we're going to drop out to a 4-hour chart. Okay, and here is that level right there. Okay, you see these old highs? It's essentially worked that 134 figure. How about this old high? See that? Let me take these vertical lines off. And sorry, but I gotta get this off. It's just drive my eye right to it. You can see that price slipped aggressively right there, and as price ran up to that old high in here, it's reasonable to expect that at least this would be a pause or a reversal, and you see that. If you go back farther, look at these highs. See that? How about if we go out to a daily chart? Here's those highs we just looked at. Look at this high. Look at the lows here. See the highs here? You don't think that level's sensitive? Okay, you saw that here. Okay, so again, let's go back down to the 15-minute chart. Price trades down from there, okay, until it does what? It finds support. Okay, this level in here, we're just going to borrow this horizontal line, and we're going to use the very extreme. Okay, now this is illustrating the facade of using lower time frames to justify the trade without having a higher time frame premise. Okay, we have the 132.10 level. That's essentially what that is, and that's a level that I've talked about in weeks since this time of this recording. If we got to a 4-hour chart, here's that 132.10 level. Okay, price comes down, hits it right there, rallies off. Look at the time it spends at support and resistance at that level. See that? Okay. When price trades down like this and rallies off, go back down to a 15-minute time frame. It was in a consolidation. So I was asking you when we were doing our first episode what you saw here. Okay, now this is the market maker business model. Okay, and we'll talk more about this as we go along, but we generally see a consolidation, a rally, a retracement, then another leg up, and a pause, and a leg up, and an eventual reversal with a failure swing. In other words, there's a high, it fails to go higher, and then it breaks down. Then you start seeing the market move lower with opportunities to sell. Okay, there are really 2 legs up and then 2 legs down, and there is a zenith point here, there's an origin point here, and a conclusion point on the right side. Okay, they build a block of orders. Okay, they rally the price up. They is the dealers. Okay, the market makers, and then they have another leg up. If you look at price very generically, if you say, okay, here's the low, and it rallies up and makes this price swing. Essentially using this low here. This is the second leg here. Okay. Now we're not looking for perfect symmetry, but the overall price structure will always be very similar to what you see here. The price move lower. Okay, we have a high down to a low. Okay, you can see the second leg here. Okay, so we have price move and a consolidation and another move lower. So that's the second leg. So there's two phases up, two phases down, but there's a reactionary high that's formed here. Okay, so they rally price up and then they sell off. So the accumulation, they accumulate longs here, they rally price up. As price is rallying, they distribute, and then they start selling on the other side. Usually what happens is folks over here are expecting it to continue, and they're buying over here. Because why? They're looking at lows over here, drawing trend lines, and they're thinking, okay, it's right at the trend line, let's start buying it, and then it breaks. And then they don't know what they're doing. So much in the same way it does it on the upside, same thing will happen here. Folks start seeing these stair steps going lower, lower, lower. They'll draw their trend line. Again, this is why I'm not a fan of trend lines, but you can see how this is a very textbook trend line. So when price gets here, okay, let's be a seller. Really? Why? Because the 15-minute chart says so, and it's a trend line. Watch what happens. Wow, we've made money. Boom, we got crushed. Watch what's happened, okay? We move into another market maker business model. We go into a consolidation, a fake rally, and they take the stops out on those that are right on the market. So they could have been buyers down in here, okay? There's could be retail traders that were being buyers down here, and they would have been right. Bang, you take them out. It activates their sell stop. Their sell stop becomes a sell order at the market. Who's going to buy it from them? Smart money. And you see this extrapolated huge move rally up. Okay. Now think like we over here. We have a consolidation, a rally, and then a consolidation, a rally, a consolidation, a rally, and a reversal of sorts, and then a breakdown. Okay. Let's look at what we're looking at here. We have a consolidation, a rally, a consolidation, a rally, a failure swing, and the market breaks down and creates a false rally, and we move lower. Move lower, rally, move up into old resistance, okay? And this is where we're at right now. So you can see there's a general repeating theme here, okay? They're not always going to be identical, but they're going to be very close in terms of their structure, okay? And this is what I refer to as market structure. You need to see what price is trying to do, okay, and key off the support resistance, use time of day, use day of the week, okay? And let's add that real quick here. You can see that the low was formed on the initial leg up, but you're now in a second stage, okay? And this is where we apply, it's more or less an advanced approach to utilizing it, but you're also implying time. Now the study of time is important, okay? So you have this price rally here from the previous week, then consolidation, and then it rallies up. So this is when you get these weeks that, yeah, you do have a low form on a Monday or Tuesday, it rallies off, and it makes a very good, potentially profitable trade. But then you have the reversal, failure swing, and it trades lower and takes out the weekly low. Why did it do that? Take the vertical lines off and take the barriers or blinders that you have on, thinking, okay, ICT said the week is bullish. That means it's going to be the low of the week on Monday or Tuesday, or certainly latest by Wednesday's London Open. So therefore, buy and hold. Well, there's a little bit more to it than that, and that gets back to where are we at in terms of the overall market structure. Okay. So now we're on the other side of the business model. So now are we going to continue to move lower? Very well could. Why? Because we went up to that 134 and failed. Okay. There's a lot of other things that we could build on, and again, I'm not trying to give you a trade, but there's certainly a lot to suggest that this could potentially become a nice turning point. If you look at the high here, down to this low, it's a very significant retracement point, and we'll just leave that for another time. But if price continues to move on higher, then we can assume that this is a very solid swing low that's formed, and we could see, this high challenge. But we don't know for certain. We just look for confluences of support and resistance with a bias in mind, and then trade on that. And overall, consistently applying that mindset, you'll see that there's as a means of finding consistency in your trading.
Okay, guys, we are looking at the time frame section of this episode. Now, obviously, it could be very daunting for you as a trader, especially if you're new, and you just sit down in front of the charts and you're thinking to yourself, what am I supposed to be looking at? Am I supposed to be looking at a 5-minute chart? How about a 30-minute chart? The guy I've read on the forum said he looks at a 2-minute chart, and how about the other guy? He looks at a tick chart, and this other guy says he ain't looking at anything but a weekly chart. So what do you do with all that? Well, the main thing is you have to keep in mind that whatever time frame you're trading, that's where you work within. Okay, so basically, knowing your time frame for your trade is your primary objective. Now, the professional perspective, okay, the frame of your trade should be at least built upon 3 time frames, and that's what we're teaching here. I'm building a large introduction into basically Alexander Elder's triple screen approach with an ICT twist. So if we're a position trader, you would utilize the monthly, the weekly, and the daily chart. Okay, and you'd be looking for monthly, higher level time frame support resistance levels and reaction levels, and weekly chart as well, and then keying off of the daily chart for your trades. Now, in this time frame, you don't need to be in front of the charts all the time. In fact, you're probably going to be trading very few setups throughout the year. But for those that have really very, very few hours of the week to put into trading, position trades may be the way to go. If you are a little bit more free and you have a lot more hours available to you for intra-week trading, swing trades might be up your alley. We use the daily, the 4-hour, and the 1-hour chart, and that's really what this series has been framed upon. The daily chart and 4-hour chart really are the institutional frames for your trade setups and your trade ideas. The 1-hour basis, you could substitute that with a 15-minute chart. It's really up to you. Okay, that's where the level of flexibility comes in. Now, short-term trading, your high time frame chart would be the 4-hour, and the 1-hour being your mid time frame, and your 15-minute chart would be your execution time frame. And obviously for day trades and scalps, your 1-hour would be higher time frame, your 15-minute would be your mid time frame, and your 5-minute chart would be your execution time frame. Now, at any one of these levels of time frame analysis, you can always break it down further to the lowest form of charting. In other words, it could go down to a 1-minute chart. But that's the framework you utilize when you're breaking down the market and how you digest it. And if you're going to be a specific type of trader, if you work with these 3 time frames as suggestions, I think they'll work well with you in terms of your development. All right, let's talk about cycles in the marketplace. Okay, we're going to be talking about some smart money concepts. The concept is basically how the market moves from trading ranges or consolidations to swings or trends, and they move immediately right back into a consolidation, and then after consolidation, people get sick and tired of the marketplace. They don't worry about getting in, or they chased the previous move, and that inside that little consolidation, or these rectangles or squares, if you look at on this chart as an example, that's where dealers and market makers establish their positions. Okay, so we do not chase the marketplace. We do not chase price rallies. We do not chase price declines. We work within these consolidations. Smart money accumulates during consolidations or when the market's not attractive. Okay, and we're going to build on this model as we go through the series, but it's very important for you to start looking at the charts with this premise in mind. Are we consolidating? Because that's the precursor is the consolidation. Then the next thing to expect would be that you release, that dynamic thrust up or down in price action where everybody gets really excited. You see everybody tweeting about it. You see every analyst saying they had it right for the last 6 months. That's really what you're looking for. You want to be in there before everyone else is talking about it. Okay? All right, we're going to be talking about the concept of power of 3. Okay, and what this is basically a understanding of how the market works on a daily range. Okay, now we're going to be looking at this bar chart. Okay, now obviously we deal with candlesticks a lot in my videos and maybe in your own trading and your technical analysis. But for a couple minutes, let's spend a few moments talking about how the open, high, low, close bar is beneficial. Now, I'm not going to give you a full treatise on this because I have actually a tutorial that I'm re-releasing that has much more insight that I'm going to go over in that, but this is going to be a brief introduction. The concept briefly is this. When the market opens up on a daily range, okay, you as a trader, you want to be participating in large range moves, okay? Like we just discussed on the previous slide, you want to be entering the market when it's quiet, when there's not a whole lot of activity, or at least when the ranges start to compress. Okay, when the ranges start to get small, people get really bored with that market and they start chasing the next pair or the next commodity market or whatever it is that's moving around a lot. That's the one they're going to move to. Well, during those small little consolidations or small inside days or small daily ranges, that's when I get really excited because I want to be in there when the markets are getting real quiet. They're like a spring winding up tighter and tighter and tighter, and eventually something, whatever the catalyst is, I don't always know or even care really to know what it is, makes the market take off, and hopefully in a predetermined direction that I was positioned in before it takes place. That's essentially what you want to be doing in your trading, whether it be day trading, scalping, or short-term trading, or position trading, or swing trading, whatever style of trading it is. You want to be getting in your position during these consolidations and contractions of ranges. Okay, looking at this example here on the left-hand side of the euro, this daily chart, just stare at this chart for a couple minutes and you'll start seeing that how the ranges get smaller. Now excluding the small little itty bitty tiny little ranges, that's actually a Sunday candle, so you kind of got to like disregard those. But before the ranges get really, really big, they actually get smaller. Okay, and there's other examples of time frames and sample sizes that you can utilize to better illustrate this, but I've been looking at this for years, and I can see, just simply looking at it for a few seconds, I can see the pattern itself, where the ranges get smaller, then expand, get smaller, get expand, then get smaller. That phenomenon, okay, is one of the truest cycles in the marketplace, and it goes over everyone's head. They don't pay attention to it, and many times when they hear me talking about it, it's like, well, that's pretty obvious. Is it really obvious? Because the last few times you took a trade, maybe they were losers. Did you take in consideration what was going on? Did you chase the market after it rallied up 60 pips, okay, without any kind of retracement or whatever? That's the nature of this this cycle, okay? And some of the best money can be made simply with just applying the consolidations to trend or swing component we just discussed in the previous slide, and adding when the daily ranges themselves get smaller. So inside those larger consolidations, okay, or rectangles where the trading range market environment develops, inside that trading range, if you start getting small inside days or small little daily ranges getting smaller than the previous days, then you have a really good scenario where it sets up where there's going to be an explosive move 1 day, 2 day, 3 day up or down, depending upon the directional bias that was the precursor going into that condition. But now let's break the daily bar itself down. Looking at the opening, assuming that we were looking for a up day, okay, or we're in a bullish scenario. Generally speaking, if you are trading in an area where it's highly probable for the market to trade up, maybe we're in a consolidation on a daily chart or 4 hour, and the ranges start contracting, okay? On large range days, this is a notepad moment, get this written down in your notepad. On large range days, the open tends to be at the opposite extreme of the daily range opposed to the close. As you can see in this example, obviously this is an illustrative example I drew with the computer, but it's going to communicate the basic premise. The open generally is on an up day, or a large range with an up day bias, and a close typically sees the open at the low of the day or near the low, with the close at or very near the high of the day. Okay. Now look at the example for a moment to the left. Notice how many, again, this is a daily chart of the euro. Notice how many times that the open is at the opposite extreme of the daily bar where the close is. Okay. There's enormous amounts of opportunity within the daily range, and that is what you should be looking for. You want to be trading at the very minimum in the directional bias of the daily range. Okay. We talked about the notion of having the higher low form in the early part of the week. Okay, so that same principle applies here, just on a daily chart. Okay, so now what this means is, if you're bullish, you want to be looking at the opening price and looking at that as your filter. So you want to be buying not very much above it, if at all really, and certainly below it. Okay, because what you'll learn is the opening price very rarely works both sides up or down before going up on an up day. In other words, price does not spend a whole lot of time monkeying around with the opening price. If it goes down, it's only going down briefly for a very short distance, maybe blow out some stops, maybe retest an old consolidation, dip into an old block of orders for institutional purposes, and then shoot straight up and continuously work one side of the market all the way through the trading session, and then closing off many times a little bit off the high. Looking at the example you have here, you can see that just about happening almost on a daily basis. The vice versa would be, obviously, on a down move, the open would be very near the high and the close very close to the low. The general principle is the low is formed briefly after the opening on up days, and the high generally forms between 1500 and 1600 GMT. Put that in your notepad, and then you test that theory on your own going forward for the next couple of weeks. Okay, let's look at a large range day. Okay, we've pointed out this one specifically here, and this is one I actually did trade. Now, admittedly, I got out during the middle part of the day because I had thought that it was going to retrace a little bit deeper and give me a better opportunity, but I missed it, and I was only able to catch the first leg of the daily trend. But this large range day, okay, came with the principles that we just discussed. Okay, we had the chart here on the right hand side is going to depict a few things. The first, let's look at this. Okay, we have the beginning of the new day here. Okay, then the market peters around. Okay, this is all Asia. Okay, and this vertical line delineated here is midnight New York time. Okay, then you see the market drop down during the European session into London. Then the market takes off, goes vertical, goes into a consolidation. Okay, and during this time, what I actually expected was it to retrace a little bit deeper, maybe come back down and to touch this high in here. But this was the New York Open trade here, and then it violently traded higher going into the latter part of the day, and then peters off from the high and closes just a little bit off the high, but certainly well way away from the opening price. And then after this vertical delineation here, this is 1800 GMT. The North American continent doesn't consider the new day like the FX market generally calls the, in Wellington being the new start of a new day. I don't consider that as a new day. Okay. Now I certainly take in consideration all of the Asian trading. Okay. But I know this is going to be very confusing, but I always count that as yesterday's trade. My new day begins at midnight New York Standard Time. Now again, it's probably going to throw a lot of yous off, but just understand this is how I break the market down. Midnight New York time to 1800 GMT time, okay, or basically 2 p.m. New York time, okay. That's the cutoff of the daily range. Everyone asks, when's the close? When does New York close, or when does this and when does that? Let's talk about the commodity market for a moment, because before FX was opened up to the general public, the only time you could really participate in the currency market was if you were trading the options market or the futures and or mid-am contracts on the commodity exchanges. And it was in the form of open outcry. Now, open outcry is still in existence today, not as predominantly as it was years ago, because everything's slowly transitioning to electronic, much to their dismay. But there is essentially a rhythm to the marketplace still based on that open outcry. The futures contract open outcry pit begins trading at 7:20 New York time. Now, what do you think is so significant about that time? That's 20 minutes after the beginning of our New York Open kill zone. Okay, why is the New York Open kill zone so cool and so easy to trade? Is because that market event, open outcry, also is going to be involved in the daily range. Okay, why 1800? Well, because at 2 o'clock in the afternoon in New York time, the open outcry pit closes and they are gone for the day. And you can see here that clearly is illustrated. There's no more volatility, very little volatility at all. Okay, let's talk about kill zones. I generally start hunting during the Frankfurt Open, which is 2 a.m. And many times you'll hear me commonly call 2 a.m. the beginning of the London session. And it's either because I'm rushing, trying to talk about something and really just inadvertently misquoting it, but just understand this. When I get up in the middle of the night to start trading in my time zone, okay, 2 o'clock in the morning, I'm in there hunting, okay? But I'm hunting essentially the move that sets the high or the low of the day. And I want to trade in a directional bias for that daily range going into London close and or 1800 GMT, okay? The London kill zone, I use 5 a.m. as my close of shop. In other words, if I haven't established a position by 5 a.m. my time, okay, I basically take a nap and come back right before 7 o'clock in the morning. Okay, generally at 6:30 in the morning, I'm peeking at the charts and seeing what's going on. Now, for the American session here, you see 8 a.m. and that's commonly what's been disclosed with many other trading teachers. Okay, but if you look at your charts, guys, many times the moves are starting about 7 a.m. between 7 a.m. to 7:30 a.m. Okay, and now you understand why, because the open outcry pit starts at 7:20 a.m. New York time. So there's a reason why there's something that generates a signal there, or a swing high or swing low that can be incorporated on that daily range to trade intraday setups, whether it be scalps or day trades. And I usually close up shop anywhere between 1500 to 1600 GMT, generally 80% of the time. And then when it's really taken off and just blowing out all objectives I had for the day, I'll leave a very small portion of the trade on for 1800 GMT, but very rarely does it ever happen. Most of the time, 80% of the time, I'm out of the market by 1600 GMT. So between 1500 and 1600 GMT, that's usually the close of the day for me. That's when usually you'll see the high or low form for the day. Okay, folks, we're looking at the Euro USD. It's a 5-minute chart. And what I have delineated on this chart here, we have these red dash lines, okay, and green dash lines. Now, what I want to draw your attention to is that I want you to see the highs and lows that form during these particular sessions. This is the New York Open session and the London Open session. The high of the day formed during the London Open, and the low was essentially almost formed during the New York session going into that 1600 hour. The next day, Okay, we have a nice tradable rally up into this area of time. It was just outside of it by two bars here, for in other words 10 minutes, and then sold off. We have a nice opportunity to get in sync with the daily trend here with a high forming in New York open and making a move lower. We have the low forming in London, and then another tradable low off of the direction formed from the London open. Here is the New York open trade, and this happened to be one that I took part in a live trade. So this is the scenario. I'll go over this because I haven't been doing video reviews in a couple weeks. Just give you this as a highlight. Okay, the price made all these multiple stabs lower and showed an unwillingness to go lower, consolidated, found a low in London open, traded up, and retraced into the New York session, going into optimal trade entry and a sweet spot, and rallied on up. Now, if you use your Fibonacci tools, here's your 162 extension, nailing it for the high. And we'll talk more about targeting and exit prices and all that stuff when we get into later portions of the series. But you can see how the London and New York open kill zones here gave you very nice opportunities for a setup. Here we have another scenario where using the previous day's low. Okay, and all we're doing here is highlighting the importance or the influence that the New York and London kill zones provide for setting up opportunities to trade. This area here, okay, during the London open, we retraced inside of this range here, and then where we had this consolidation and the market moved out of it. This displacement can only happen when there is a large entity behind the move. Okay, retail traders will not cause this. Okay, and then price retraces back into it, and then what's it do? It rallies up again. Where's it rally to? To take out old highs in here that were too clean. Okay, this is way too clean, and price stabbed up in there and gave an opportunity to take profits if you were a short-term scalper on the long side, but the bias was lower. Okay, and we talked about earlier, you know, how it's important to focus on these higher time frame key reaction levels, and that was the reason why we saw this really explosive move lower. The high formed during the New York open session, and the low actually formed in the New York session as well. The following day we had a short-term high formed in here, but a tradable low formed off the fiber in the New York session, making the high here and then closing the week out as we see. The kill zones are where you bracket in terms of time. Now, by itself, it doesn't do anything for you. You have to have an understanding of support resistance and key reaction levels and directional premise to frame your trade on. But inside these little pockets, okay, and really it looks like this if it's hard for you to see. It's this whole window right here of time. Inside this block of time is where the scenario of a trade should form, okay? And the same thing goes for the London open. Inside this area or a small little pocket of time and price, that's where the scenario is going to unfold for you to take a trade, okay? So it allows you to really hone in like a scope on a rifle, like a sniper, to zero in on where you should be sitting down in front of your computer. Okay, if you're a London open or London trader, this is where you do your business. Okay, if you are a London trader and don't trade during the New York session, you're cheating yourself, because there's a lot of times the setups that you may have missed being incorrect or just missed altogether will give you an opportunity to get in sync with that move during the New York session. My best advice as a mentor would be to really try to learn that New York session. It's very comfortable to trade as a North American trader, unless you're on the West Coast, and if you're out there on the West Coast, you know, that's just something you're just gonna have to suck up, because there's nothing more about it that I can say that you know, you guys got generally very favorable weather. So if this is the thing you have to trade in for it, then haha. So anyway, the New York session, obviously, to me, I think is the easiest one to learn. It's the most forgiving because it gives you the London session behind you as a a catalyst, just a frame you trade off of. So if you have a higher time frame support and resistance level noted, a directional premise in mind, and then you have the London session keying you in that same direction, man, you have a loaded deal, as you have here in this example on the 4th of September. It's going to be your homework to actually go through the next week, okay, and have those time windows bracketed out. Again, for the New York session, it's going to be 12 GMT to 1500 GMT, and 6 GMT to 10 GMT for the London Open kill zone. If you do this for a week, okay, my advice is to see what happens during these windows of time, okay, and when there is higher time frame reaction level around these same pockets of opportunity in terms of time kill zones. And then you'll see a confluence of events unfolding. It's not a test, okay, it's just a learning opportunity for you to familiarize yourself with price action. Okay, we are looking at the ICT market maker buy model. Okay, this very crude depiction of how markets move. Okay, and the premise is this: the market makers start building up orders in here. Okay, and a whole price within a clearly defined range. There's not enough buyers to keep it higher, and there's not enough sellers to take it lower. So what will happen is the market makers keep it in a tight range to accumulate positions. Okay, now what they want is to hold the market in a holding pattern to establish a premise for them to take the market the other way. Same thing can be seen here, just in reverse on a market maker sell model. So they're buying it all up in here, okay? They're distributing a little bit here. They're distributing a whole lot of it here. They're dumping it, okay? And then when the market pulls back, a lot of traders view this area as another continuation pattern, much in the same way it does here, okay? Or maybe this is a bull flag, okay? And what they'll do is they'll buy it with the expectation it's going to continue moving on higher. But what will happen is they'll have buy orders, in these small little areas of dealing ranges that we're going to discuss later on. And what will happen is they'll pair orders up and stack up all kinds of shorting opportunities, and they'll distribute the market very heavily. And what will happen is once they get a block of trades on the other side of their position, essentially, they will do a real quick repricing, and it'll trap traders. And what will happen is that you've done this before, and you know exactly what I'm talking about, even those guys in demos. You put a trade on, okay, maybe you bought it up in here, something like that, okay, and the market drops down hard, okay, and you're thinking, okay, well, maybe it's just going to come down here and retest some resistance, turn support, and then it'll resume up, okay, and then you start seeing this little pop up here, and you get excited, thinking, okay, I'm getting ready to go back to break even. But the dealers know that, okay, the market makers already have these folks trapped, and if you went in there and you bought, you're trapped just like they are. They don't want to give you an opportunity to get out of that trade, okay, they're going to keep you on a negative float, okay, you're going to be below the dealer spread, okay, and maybe even pips, and negative beyond that. Okay, and then what happens is they'll do another repricing. And now here's what you're going to do. You're going to say, okay, well, we're just retesting this whole area in here again, and we're going to find some support, but it blows through it. Okay, the dealers will go into another consolidation thinking, okay, well, I know what this is. This is one of those retracements where from the low up to this high, we got one of those ICT optimal trade entries. Nope, not here. What will happen is they'll one more time, they'll run it, gun it lower, and they'll take out the stops that are placed on the folks that were right, that bought this rally here and just held on for too long. Okay, so it's an accumulation, some distribution here, or reaccumulation for new longs. Okay, and then when they get up here, they distribute all of this in here, but they do it very quickly. That's why when you get up to these levels, price doesn't stay up there very long. Why? Because they're doing a massive distribution, and you see the price really drop off fast. But when it drops off, it'll give you a little bit of consolidation, one more rally up. When it gets on the other side of the zenith of this price move, when we get to this start rallying up, this is where you start selling. Okay, and if you can identify this pattern, it makes your trading a whole lot easier because you understand what they're doing and where they're taking price. Okay, guys, we got some key levels here noted on our time frame of the daily chart, and we're going to give some examples of what is a market maker profile. I'm going to give you a buy example and some sell examples, and the way you utilize them is obviously you have a higher time frame support resistance level, but they can occur on any time frame, but they're more apt to occur on a daily, 4-hour, and or an hourly time frame. And then if you have a understanding of what the directional premise is on a lower time frames, you can use them on 1, 5, 15 minute, 30 minute, and hourly charts and such. But for now, we're just going to give you examples on finding off of a daily time frame. You can see price trades down into this level here. It's an old support, and all we did was round it to a 127.60 level. We just calibrated the level to a round number. We're going to look at this area here for a buying market profile, for market maker profile, and then we have one in here trading into this resistance level. Okay, and then we're going to go and look at the sell scenario that we called in the last video and how it was a market maker sell model. Okay, so what we're going to do is we're going to look at this particular day, and the actual candle comes in at July 9th, 2013, and we're going to start with an hourly perspective on it. Okay, and all I did was use this to highlight the time. Okay, we have market in a consolidation. Okay, we have a consolidation here. Market breaks out of the consolidation and then retests that same consolidation here. Trades lower. Okay, and there's a couple minor little retracements to get in sync with that move lower, making the actual low here, and then a false swing lower. This is the actual high. Oh, I'm sorry, the actual low point of the market maker sell model in here. Okay, and then price rallies through, takes out this high here, and very little pausing at all in here. It just explodes. And where does it explode to? Above the consolidation in here. Okay, so again, the same price model here in this fractal pattern is seen on a hourly basis. You can see ultimately it comes back and trades even further. If we go and look at the daily chart again, and we're going to look at this example here for a sell. Okay, right in here, and I'm going to zoom in so you can see this candle right there. Okay, these levels of key support resistance on the higher time frame would be noted in advance. As price trades up into it, we would expect to see a market maker sell model unfold. And let's go down to a 15-minute. Okay, you see that happening here, and let's actually go down to a 5-minute. See a little bit better. And just take this rectangle off because it's no longer needed. Okay, we have the consolidation, to move out of the consolidation and then retest. Now this part does not have to happen, okay, but generally you'll see it happen. And then there's a continuation moving up, makes the high or the capitulation portion of the buy model. Now it turns to the sell side of it. Okay, so we are now in a market maker sell model profile, and we would expect to see this consolidation ran out as you see here. Market moves down, consolidation on here, another break lower. Where's it trade to? Below the consolidation where accumulated positions were taken on. And you can see ultimately that's the price model right there. Okay, and let's go back out to a daily. Okay, we're going to look at the 134.30 level. Okay, see this high here, the lows in here, the bodies of the candles as well. So we have 134.30, small round number. It's just above this high as well. And we're going to zoom in and look at this profile right here. And as price moves up into these levels, we would reasonably expect to see a market maker sell model. We're going into an hourly time frame. Yeah, and we're going to zoom out. Okay, we can see the consolidation. Let's take these vertical lines off, clean it up a little bit. You can see the consolidation in here. Consolidated, moved out, came back, retested the consolidation, moved on up, false rally higher, breaks down, rallies again on the other side. And again, this is the sell model, so again, this is the sell model, so you're going to see price run out this consolidation on the low end. You can see that happened there. Okay, so that's the market maker sell model. And again, we called this market lower here before the actual move ensued, given some further credibility to the analysis concepts, and it's not always hindsight cherry picking. All right, let's talk about market orders and how dealers work within the marketplace and how they perceive traders' psychology and how you can pretty much get close to what they're doing without even seeing the order books. All right, we're looking at a conceptual idea of what market price is right now. And we're not going to have a chart. We're just going to conceptually talk about the generic principles associated with how reading the market. All right, let's assume for a moment the market price moves up to what we considered a key level, okay? Or it could be moving down to a key level. It doesn't matter, but we're saying for the moment right now, we are trading at a highly sensitive price point that reacted most recently, or maybe a couple weeks ago. There was a significant reaction to that same price level. So now market moves, whether it be up or down, we now have a market price that's equal to or very close to that key level. The question comes to mind is, where do we go from here? Do we move higher or do we move lower? When you're watching price, what you're going to be looking for are clues. Okay, there's going to be a fingerprint, if you will, of what may be unfolding. And generally what happens is above the market price, okay, there are protective buy stops on those that have maybe put on net short positions. And many times simply above that, just a little bit more, there's going to be pending sell limit orders for those that have been possibly being long. Okay, in other words, we have net long traders in the market and we have net short traders in the market. The net traders on the short side want to protect their position, so they're going to have their protective buy stops somewhere above the market price. And again, the premise is this market price is now trading at a key level. Okay, and because traders always have a differing view, even if the marketplace is a implied support level, folks may be really looking to sell short. Okay, and we're going to talk about that in a moment. But for those that have saw this level as a potential support zone and they want to be expecting some kind of a bounce up, they would have pending sell limit orders to exit some of their position and or all of it for a profit. And then obviously folks that expect to see it go up only if it proves a little bit more that it's going to move upwards, they'll have a new long buy stop. Okay, so in other words, we have three types of orders that exist generally above current market price. That being pending sell limit orders for those that are net long, protective buy stops on those that are net short, and new potential buy stops for those that want to enter on buying strength. On the converse side, obviously you have, for those that are buying this particular price level, you have protective sell stops protecting what they believe there is a potential buy scenario unfolding. Then you have sell stops that are resting below the market price for new short selling. So in other words, they want to sell on weakness. And below that, usually you have pending limit orders to be tripped for covering short positions. Okay, in other words, they're using that type of order to exit on a profit target objective for short positions. The question is, where are we most likely building up orders? Okay, and it's very tricky in the beginning because you have to spend some time looking at charts. Okay, this is going to come with time. The psychology behind price action is very readable. Okay, and it's by using these simple 6 types of orders around market price. So let's talk about a little bit more detail of how market makers pair orders and how orders stack. Let's assume for a moment that there is a highly sensitive price level of support or resistance around that 132 big figure. Now, when we look at a big figure, okay, and before I go any further, this could be a mid figure, okay, and then obviously the levels above it being respective in terms of what we have here as an example, but keeping in true form of the institutional levels we like to follow, which are the big figures, the 20s, the 80s, the small round numbers, okay, and the mid 50 levels. Okay, if price trades up to 132, don't expect 132 to always simply hold price back. Many times you'll see price trade up to that level and there'll be orders around the 10 level and around the 20 level. Many times you'll see price, even if it's going to go lower longer term, many times they'll sweep price up to the 10s and the 20s. And the reason why is because folks like to put their orders at odd numbers and such, okay, but really the institutional level traders, they work around small round numbers, okay, the 10s, the 20s, they'll use those levels because it allows them to clean through particular price levels, okay. But if you think in terms of the big picture of how these market makers and large bank dealing traders work, they're going to work around these round numbers and always expect them to try to sweep to the next small little round number, because that's generally where they'll take price and it'll clean out all the guys that want to use a stop loss. Okay, maybe they sell short at 132 even on a limit, and maybe they saw price drop down to 131.90 and they're salivating because they think it's going to go to 130. Okay, so they put their stop loss at 132.03. Okay, well, the dealers know that. Okay, and they're going to take price up, and just for good measure, they're going to run it to the 132.10 level, and that'll clear out a nice block of trades that would have had pending orders resting above it, like we just discussed in the previous slide, and allow them to promote liquidity not only for themselves but other orders they have to do transactions for. All right, let's take a look at an environment where the 132 perhaps is a clearly discernible resistance level. Okay, and we're going to assume that market price is down here below that particular price level, and generally you'll see this type of action. Okay, they'll take it up to the 80 level, okay, and price or retrace, pull off very sharply. Okay, and everybody understands, if you've been looking at the markets and in any capacity, that the 80s, the 20s, and the 50s and full figures are very sensitive psychological numbers. Okay, and if the dealers can bounce price off of there, they'll trap a lot of traders thinking, okay, that was the high of the market. Then what'll happen is they'll reprice, okay, and get folks that maybe didn't believe that was a high and they think it's still going to go to 132, they'll more or less buy that market up. Okay, but then what they'll do is they'll take the market below the most recent swing low and stop those traders out. So now the folks that think on the short term that the price is going to go to 132 are now scared. They don't want to get in the market now, so they took those individuals out. If they were taken out when that recent move down below the recent swing low here, okay, what is below there? They're going to put a what? Protective sell. Okay, if the dealers take the price down below that, that sell stop becomes a market order to do what? To sell at the market. Who's going to buy it from them? The dealers. The dealers will buy up that pocket of liquidity, okay, and then they'll reprice, and they'll take it up to that 132 figure, clearing out the stops that would have been resting at the 131.90 for those that went short here. So now, is there anyone short? No. Okay, so where does the dealers exit their position that they accumulated here? At the 131.90 or thereabouts, because that's about where the stop loss on the short sellers here would have their orders resting. So they clear out the pending orders and take it all the way up to the 132 figure. The next repricing comes in, they sell off. Folks say, okay, well, this is the top of the marketplace, so let's start selling. Okay, so they go short here. All of a sudden, you'll see the dealers take price back up again, and they'll clear out the 132. Why? Because the folks that have been watching that 132 level, once it trades there one time and starts to trade off, they think that's it. Support resistance is perfect. It never has any blurry lines. It's crystal clear, laser guided, okay, and price is always going to stop right on that 0 level. It doesn't, guys. You got to have some flexibility and wait for the sure sign that this thing's going to turn around. So when they clear all the way up to the 132.20 level, now folks that were looking to sell, they're scared. They don't want to get in the market now. They don't know what's going to happen. Why? Because they watch the guys get blown out here. They watch the guys get blown out here. And this creates that pattern 3 drives higher, or 3 Indians, as it is in the Street Smarts book. They'll do a massive repricing. They'll take out the swing low here. Why? Because there may be traders that were net long in here and got smart and realized this was probably going to move higher, but they don't want those guys in the marketplace either. Okay, so they're going to drive them individuals out as well. Then they'll take price back above that 132 figure or rate at it. Okay, and this is typically when the market really makes its pattern of going short. Why? Because we have a breakdown in market structure after we clear out the orders that stack around these key levels. Then you'll see price do a dramatic repricing and take out all short-term lows and anybody that would be net long in that position, and now they're trapped. The next portion is then they'll get traders to think, okay, this was it. This was a false resistance level. Maybe this was one of those patterns where it looked like it was a top, but it really wasn't, guys. So let's get on board, and they'll do a real quick repricing up. This is where you get the nice optimal trade entry sell short patterns. Okay, and that's the one you want to be in on. And then you see these sustained swings lower begin. Now we had a homework assignment from episode 3, and it was trading in the zone, okay, or stalking in the kill zone. And we're going to discuss that here. Okay, and what we're going to do is we're going to move down into an hourly chart, and I'm going to delineate the 9th of September. Okay, so everything right of this vertical line basically is referencing where we are in terms of the last recording and posting in this video series. And what we're going to discuss, okay, as an example of the ICT kill zones, we already had a premise in mind based on the analysis of the interest rate market and how it would have a magnetic pull on price upward. Okay, and with that understanding, we're going to add the ICT kill zones, and we're going to add the vertical day delineation. Here is the September 9th time frame. Okay, and we're just going to be tracing this whole period on the upside, and we're going to zoom in. Okay, and what we're looking at again are the red dashed lines here. Okay, this basically is encapsulating the whole London session. Okay, and the green in here is basically encapsulating the New York Open or New York session. Okay, and what we're looking at is how, by focusing on catching a decline or pullback within that specific time window each day, with a premise in mind where we most recently moved away from and where we're going to retrace back into. In other words, we had a range initially during the London session here. We saw it rally up in here, then it retraced within that range, the range between this high and this low. Okay, that retracement in here was an opportunity to be long. As the market moved higher and expanded its London session range, okay, we had another minor pullback. It pulled back to a dealing range high in here and then moved on out. And then we entered into the New York kill zone, rallied up, the retracement in here, while there was nothing sufficient over here in terms of support resistance, we will talk about these pauses in this video module and how it's useful to you. But price moved up, eventually moved and made a high outside of the New York session, and or at least the New York kill zone. It's not the session itself that was outside of, but the time window that I clearly defined. Now, this day here is Monday on the 9th, okay? Now, that was the date that we released the previous installment in the series. This is the Tuesday, okay? And now what we're going to talk about is how we use these sessions, okay, with the understanding of expectancy moving higher in price, okay? There's highs and lows within these time windows, okay? We have the low, we have a high, and in between there, okay, any swing high or low is useful. This one here, okay? Inside the New York session, okay, we have a low here and we have a high here, okay? And on the following day, on this Tuesday, this was September 10th, we have the range from here to here for the London session, and the New York session is here, okay? So inside of that, you can see that there's swing highs and swing lows that are useful as well. By understanding that, okay, and understanding the concept of the range or previous day's range or session ranges, okay, that being here's the previous New York session range. This is a low in here, okay, and what we'll do is we're going to highlight an opportunity that could have presented itself to you as a trader from that low to the high, okay, and I'm going to move over here. You can see how price moved down into the optimal trade entry area here, which is between the 62 and 79 cent retracement levels respectively. It went right down to the sweet spot, which is essentially the 70.5 Fibonacci level, okay. So we have we did deviate outside of that range here, okay, by the defined terms of the ICT kill zone. So on Tuesday, we saw the market make a significant low here and then rally up, okay, and going into that Wednesday of that week, we saw price move down, making a low in London, okay, in the London kill zone when it would be reasonably expected to form. Okay, and you could take the low from the previous day up to the highest high prior to it moving into the London session. Okay, because what you're doing is you're looking for that retracement back inside of the range. Okay, and again, we see the low to the highest high here prior to it moving into the London session. Okay, price comes right down into, again, the optimal trade entry region, and price rallies up. Okay, if you initially missed that opportunity, it gives you another opportunity to catch a ride on this move up in the form of this pullback here. So you could use this swing low, and again, let me take this off because we're already getting busy. You could use this swing low to this swing high in London, and you'll get this right in here as a retracement. Okay, and don't be thrown off also with the breaks between, again, let me show you here, the time between the London kill zone here and here. There's an overlapping between these two sessions that is very busy. Okay, there's a small little period around 5 a.m. New York time or 10 GMT where you may catch a little bit of a pause or a breather. That's not guaranteed to happen always. Many times you'll see prices continue on blow through that time pocket of 10 a.m. to 11 GMT. It would be foolish of me to advise you to always expect it to be a little pause in here, but you can reasonably expect it. Treat it like a lunch. Okay, where there's a small little consolidation and all of a sudden it'll take off in the trend direction that's established by the London session. Okay, so we have a low forming here on this day, again looking for retracements to buy off of. This was one, this one in here, and then you have one in the New York session here as well. You can take this swing low and to this high here, okay, and the 62% retracement level, and it may be a little difficult to see, so I'll do my best to draw in a little bit tighter to see that. The 62% retracement level lays right on top of that line that delineates the New York session at the beginning, at least the boundary about time, and then price rallied on up. I actually took this trade, okay, so it's not like it's something that's purely hindsight, and if I'm questioned or whatever, I can show you documentation about the trade and the actual real results, not a demo trade. And the opportunity to continue moving higher in intraday in here also was available, and you could have caught some further upside as well. Right in here, okay. This was that move we were discussing, and here we have the range from the previous day's low up to the highest high, okay, right here, prior to moving into London and New York. Okay, here's New York down here. You can see how price moved to the 79 cent retracement level, okay, and we're going to talk about why this may not have been a good idea to trade, okay, looking for a long, because of something going on over here, okay, but that's later on in the video, guys. I know. teaser. Price rallies up in here, okay, nice opportunity, okay, just to be a buyer specifically looking to catch longs, okay, the range available was 68 pips. You could reasonably expect to get 30 pips out of that. Okay, and there's absolutely no reason why one couldn't have taken 20 to 30 pips comfortably out of that move, even with it retracing and returning back into this this range here. We have a low here. Okay, we have a low in here formed, and using that to the high formed right here. Okay, price comes down, deviates the 79 cent trace line briefly, just briefly. Okay, and then gave you a little tradable rally in here to the tune of about 25 pips. There's nothing wrong with that. And if you consider the overall range of this price swing from here up to the high, and as it retraces, we had the 79 here and the 70.5 level here, respectively. And then look what come down one more time, found the 79 saturation level as well. One more time, bouncing off it like we did here. Just violated this low just by a little bit. You see that? If price does that, it's usually a precursor to something pretty significant. And you can see how clean these highs up here were. So you can imagine what was resting above that. You can see that was the case here. They took out all the stops with that huge weekend gap, blowing out all these highs that were way too clean. And that's classic ICT work there. You can see the results of why I say when levels are too clean, that you can expect a pocket of stops to be sitting up there, and they will gun those bad boys out. And they did a handsome job of it that week. Okay, and price moved again on Monday. Small little rally here in the London session going into New York, okay, before a retracement deeper. Okay, now let's look at something, okay, and it's a very cool technique, and I dubbed it an hidden optimal trade entry. And for those that aren't real fans of my work, they find it rather silly to suggest that something might be hidden and therefore be useful, but it's really not more than simply looking at an idea of support and resistance, okay, which is what we have here. I think it would be hard pressed to find anyone that would really fight this as being a discernible level of resistance. Okay, we saw it bounce up here, 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 okay, and if price was to get back above it, as we see here, we would expect it to be what? Support, right? So we would have a role reversal, if you will, okay. But simply because it's an expected level of resistance here, it may not come back down to that level anytime soon, but it still is useful to us as a point of reference, because between that level and where price opened up and rallied up to here, okay, that is a range. This right here, this point here from this candle's low to this candle's close here, this is a gap. Now, while there was no trading there, okay, you have to understand that this is still a range. Okay, that's a range. This is simply no trading between this price point of the close of the previous Friday and the opening on Sunday. There's no trading in there. It's all, the liquidity is none, zero, okay? But because price is trading here, you still have to consider that as range, okay? It just means that there's gaps in between these two price points. And usually the market finds a way to fill those gaps, but not right away sometimes, okay? So what that understanding is, with this gap or without this gap, if you ever see a discernible level like this, okay, where clear resistance and support resides, if you take your fib and anchor it right from that price point, and you rally it off that, take it up to the highest high, okay, when price retraces, basically what you're saying is it's retracing into this range. Gaps don't have to fill also. But again, we have this low in here, okay, that was an opportunity to catch a short-term little pop in the market, again, focusing only being a bull. We have price moving into a larger consolidation, okay. We do have an opportunity to see like this low here to this high. This is an opportunity here where you could potentially look to be a buyer in here, okay, but with this gap like it is here, it's a lot of uncertainty where it may try to reach that. You could be a buyer here, and let's assuming that was the case, price was able to move up strongly in this case here with FOMC release in here. But this day here, okay, if we use the same premise that we had that same support line, okay, let's go back just a little bit so you can see a little bit clearer. We're going to use the same premise, that support line, and we're using the kill zones again as guides. And this is the range, the highest high prior to going into the London and New York sessions. Now again, we had FOMC coming out this day, so you have to expect price to just more or less consolidate prior to going into that specific release. it just was unable to breach that 133.25, 123, I'm sorry, 133.23 level in this area here as support. Never even came down to it, never needed to, and then just launched vertically on the upside. Again, keying off of the London Open and New York Open kill zones was useful here because the low actually formed on the day during the New York session, and price moved on higher, then went to another consolidation going into the close of the week. Again, our previous understandings in the previous videos that we see price when it rallies large like this is a big daily range. So what do you think is going to happen with the average Joe? He's going to get in the market and say, well, I'm going to be a buyer now, and I'm going to be expecting this thing to repeat the same similar move. Not always, and certainly not off of an economic report, because what will happen is that there's going to be some rebalancing, okay, and what they'll do is they'll consolidate and more or less pause for a moment and reflect on whether or not this was really needed, okay? And this is very illiquid, a lot of gaps in here, okay? So it was in a rush to get somewhere, and it held this 135.30, 135.50 range, okay? And price again moving in a consolidation. Looking at how price moved like this, we are in a wait and see mode when this happens. Even though we are bullish traders, when price moves so aggressively like this short term, okay, and we're talking about a move intraday, in one day, moving 212 pips in one day. When that's a huge range for one day. When you see that, okay, expect small ranges. And this is what you see here. Small ranges, small ranges, small ranges. And then what you're going to wait for is discernible signs that we have an opportunity to trade. Okay, and let's drop out because I'm a little too close. Here is that FOMC release, consolidation, small little retracement, small little retracement, small little retracement. And then finally, we get some market structure shifting to the bullish side. And then you can see, and that what I'm referring to is this break here, this high. It made it very convincing rally, which we're going to talk about this type of price action and what is so useful about it. You have an opportunity to see this range. Price comes down to the 79 cent chasing level. Small little violation, not much, but this is an opportunity to be a buyer. Again, focusing on the time window and the kill zones. We have price rally up on out of here. So basically what we just discussed was an overview of how important understanding the kill zones role in trading, okay? And again, just focusing on one side of the marketplace. But simply because it's usable in every market condition does not mean it's going to be a trade in every market condition, okay? A lot of folks are struggling with directional bias. We're going to talk about that in this video module. We're going to talk about the importance of not doing anything. My trade frequency is very small. I used to trade a lot. You don't have to trade a lot, okay? The tools I'm sharing in this video series will allow you to cherry pick. These concepts that's being divulged in this specific trading plan series is designed for you to catch those one shot, one kill weekly hauls where you're just waiting for that really good setup for the week. Make your weekly objective. Don't care if it goes anything beyond your normal expected in terms of if it's 50 to 100 pips for the week, whatever. This approach will help you do that. It'll help you get in that direction of being consistently hauling that game. Okay, folks, we're going to be looking at directional bias framework. And before we get into the specifics, I want to ask you a question. What makes a trade high probability? There are certain clues that are left in the chart that's very clear if you understand what you're looking for and how you can use those moving forward. If we understand that our trading is in sync with that mindset, that's what causes us to qualify or quantify the trade as high probability. Why is it high probability? It's because it's moving in the general tide that's been established by the larger dominant institutional trading. So if we are in sync with that tide, or if we're in sync with that market momentum, okay, we are not trying to be contrarian in regards to fighting the strong-armed smart money traders. Okay, they're going to take the market where they want it to go, regardless of how many indicators you have on your chart, whether it be your electronic little trading programs that you created and typed up, and maybe you bought it on the internet and it's made a lot of money in the past. Those absolutely are worthless unless they're in sync with what the large institutional traders are doing. Okay, and the only way you understand what they're doing is by price action and leading indicators such as we're going to discuss in these next two sections. And I promise you, you're going to jump about 20 light years ahead in terms of what you're understanding in price action and prognostication in terms of technical analysis. Okay, that's a promise, guaranteeing it. Okay, so now let's take a look at the ICT no-brainer directional bias concepts. Okay, and I say that with tongue-in-cheek because I've been asked so many times about directional bias and how do I get it right more times than wrong in terms of where the direction of the market's going to go, either be short term, intermediate term, or even long term. And it's simply a matter of understanding higher level charts, support resistance, price action, and the overall tendency that the market will continue to move in one direction or another until something of equal or greater that may cause a break and shift the tide on the higher level charts. So if you have that understanding, every little minor move on the intraday charts, okay, are meaningless in regards to higher time frame unless you understand how to apply them. And what do I mean by that? We'll use this rally from here in July. Okay, from the lows made here in the fiber, again, Euro USD is the daily chart. As the market moves from this point here, okay, and we're just going to quickly identify the ranges here. Okay, this point here, and I'm just roughly just dropping it. It doesn't have to be the exact. We're just talking about a specific move in price. Okay, from around the 127.57 low to 134.50 level. Okay, that's a pretty significant means of movement between one point to another. Now, in terms of pips, we're talking approximately almost 700 pips rally from there. Okay, and we were talking about the cable and fiber making a low back in here, both this point and this point here. So this is no surprise to us in terms of ICT concepts. If you go back on YouTube, I actually talk about the cable actually making the very low well in advance, based around some of the principles we're going to talk about here, and also I'm going to build upon what's already been released in my previous works. So now, if we understand this has been established, okay, this price move has been established by the large institutional smart money traders, okay, those that have huge blocks of trading that will push the market all over the place. It does not mean that there's not short-term selling opportunities in here. Okay, I'm not negating the effectiveness of short-term or day trading contrary to the larger time frame. I'm not saying that, but this series is really designed to get you focused in on only trading with this tide. Okay, and when you start trading with that, it's the same thing here from this high to this low. If you were looking for just shorts in that environment, your trades, number one, are going to be quote-unquote high probability because you're trading in sync with the higher time frame macro perspective, okay, because we're looking at a daily chart, and this flow, okay, of orders moving lower, okay, is going to drive pricing lower. Even though you'll see these minor little blips going higher intraday, okay, those are rallies that you sell into, much in the same capacity on the flip side of that. All during this point here, any decline just sets up a retracement in a up move. Okay, so you're going to be trading retracements lower into a upswing in price. Okay, so you're basically buying dips in a rally, and you're selling rallies in a decline. Okay, so as the market's moving lower, you're going to be looking for rallies to sell into. That flies in the face of what generally neophyte traders anticipate or expect to do, rather, okay, or react to. Okay, because generally retail neophytes don't have skills to anticipate. They simply react. An economic report come out 5 minutes ago that they had no idea was coming because they never pay attention to the economic calendar, something that a seasoned professional will always consult prior to the week beginning. In fact, I know what's coming for the entire month, and I have certain dates that I circle where there's going to be high probability volatility, okay, because I view market economic indicators and reports that come out methodically out throughout the entire month. These reports, okay, are injections of volatility, and I look for them to set up or confirm a continuation of an existing move I may either be a part of or looking to be a part of. So I'm anticipating. You want to get to that same mindset as well, okay? And the concepts that we're going to be learning in this particular video itself is going to be hugely impactful to your trading if you apply it correctly. So let's go on and start working on the directional bias concepts, and hopefully you guys are all frothing at the mouth, ready to devour what is going to be shared here. All right, so again, with the daily chart, what you're going to do is again, using the MT4 platform, you just go up to Insert, go to Indicators, you're going to go down to Trend, you're going to go to Moving Average, and you're going to be using the 18 period moving average, and it doesn't matter really what colors you use, we're just going to go with this, and then you're going to go and add another moving average, okay, and make sure it's exponential. It just, to me, it just gives you a better smooth factor in terms of the moving average. In the next period, you're going to be using a 9, and you want to have this color a little bit different, so we're just going to go with red. Now, the importance of having a moving average set like this, what it gives you is it gives you insight in terms of where the institutional flow is. When the 9 period, or in this case red, moving average is below the blue 18 period, okay, that establishes a bearish framework, okay, in other words, or I like to call a sell model, okay, or sell program rather. And what that does is it gives you the green light go to look for selling opportunities to be a bear, okay, or you want to be selling into rallies, okay. And when the 9 period is above the 18 period, what you're looking for is buying opportunities, where you want to be buying a dip, okay, intraday or over the course of a few days if you're a short-term trader. As we make a retracement lower, okay, all that's doing is it's creating a new buying opportunity, okay, and that's what keeps you on the right side of the marketplace, and you arrive at what was discussed a few moments ago, what classifies a trade as high probability. This is high probability that, but because I'm ICT, that's not enough. Okay, I got to take it to the nth degree, and we're going to be looking at how we can further amplify the effectiveness of directional bias understanding with, now we're going to look at a series, okay, of we'll just use this little area too. Okay, and here that was a buy area from this point in here to here was a buying area, and right in here became a selling framework where you're really just focusing on being a bear, and we'll just use that because that's a nice little price swing in here we can work within. And what I'm going to do now is I'm going to take the moving averages off, because we've already established where the averages have communicated the bullishness or bearishness that we should be focusing on. Okay, so now with those moving averages away, we're going to apply now market structure and order flow, okay, and or market flow, whatever you want to call it. But the premise of where swing highs are taken out to the upside, okay, that is momentum on the upside, in addition to when you have these little areas where the market is generally looking to move higher or lower based on these two components blended together. All right, in here we have a fractal high, or basically a swing high. In other words, it's a candle with two lower high candles on both sides of it. For me, in my trading, I simply use this candle with the higher low here, with the lower high here and a lower high here. Okay, between this pattern, this candle, and this candle, that alone would have presented a swing high to me, and if that was violated on the upside, you know, that would have been enough for me. Okay, we have a swing high here, we have a swing low here, we have a swing low here as well. Now, as price moved above this swing high here, right there, now we have both swing high broken out, or market structure has shifted upwards, while we're in an area where those two moving averages are implied momentum is bullish. Okay, so from this point on here, we are looking to be a buyer. We're going to be looking for a retracement of some sorts, okay, to be a buyer in. Okay, now you see a minor little retracement in here, and then it rallies off. Now, even though we have a bearish candle here, okay, we did move higher. Just in terms of pips, from the time it broke this swing high here, we're going to use that range to the high up here. That's 179 pips. Okay, 179 pips. That's inside of 1 week. Do you think you can get 50 pips out of that? Is it reasonable to think that one would be able to? I hope you think that, at least. Okay. Again, we have price still above this swing high, and the only recent swing low prior to that point is here. So as long as price doesn't break that swing low, we are still bullish. We have a swing low form here, but notice that that's the only one since this one was formed. So market structure and order flow suggests that we are still go for buying opportunities. Okay, now price retraces again, okay, inside of this range, and we broke this swing high here. So when that breaks, this is the range right here. This is that little price move here. If we looked at just that range alone, again, we're working on a daily chart, guys. This is not an intraday chart. If I look at using the fib, trying to draw it so you guys can see. Here's the 79-cent retracement level right in here. Okay, now true, it violated just a little bit, but ultimately it spent very little time, okay, blowing through it, going on the downside, and then we moved higher again. That by itself is insightful because, number one, it allows you to understand where these fractals are forming. But we have a price rally from in here up here. Now we're going to talk about how this could have been viewed in advance before this happening, where over here something goes on that's useful to tell when there would be an opportunity to be a buyer. But before we get to that, here's another opportunity just by using the range. That's 130 pips from that point to here, again within a week's time. So there's plenty of opportunity to be profitable, okay, and catch your 50 pips or so a week. And again, I'm trying to give you a realistic low end objective that flies against everybody else teaching that you got to make 2,000 pips a month. Now, even in here, now this is why I don't like candlesticks, because it's very deceiving if you are looking at price action on a specific manner. And then what I mean by that is this: we have a low here, okay, and if you look at the range between this low of this candle to this candle here, we have a price swing. Okay, if you looked on a lower intraday price model, you'll see that this is a very nice price swing. Okay, it's disguised many times because many of you folks don't even look at a daily chart, but this here is a range. Okay, this is a tradable range. If you look at what was available from that retracement, okay, again, cancel the idea of this being a bearish candle, this a bearish candle, this a bearish candle. Price moves from this low to this candle's high here. It's 123 pips again. That was made during bearish candles. Okay, even though the market did come down here, I'm not ignoring the elephant in the room here, if you will, on this 2 or 3 day down move. I'm not suggesting that didn't occur or wasn't significant. What I'm stating to you is if you stick to the model of looking at the low to high and then retracement during an ideal time frame, okay, notice we didn't break this swing low that formed here. We came down into the range between that candle's low and this candle's high. If we use our fib, okay, pull that up, okay, we have a reasonable idea where to anticipate, again, where the low should form. Okay, and if you looked at, and I'm probably splitting hairs, but I really want to communicate this well, we're only talking about 11 pips from where the 79 cent tracer level is and where the actual low of that candle formed. Okay, so again, when we get to stop loss placement and overall risk controls, you're going to see that there's simply no reason to fear where you should be placing your stop at. Okay, there's no reason to guess as to am I going to get stopped out, and fearing it also, because if you get stopped out where we're going to teach you, you need to be getting out of the market there. Okay, because it's probably going to be much more of a move in against you than if you were to stay in it. Okay, so we have an opportunity to be a buyer here as well. The market comes down, creates another consolidation, and then moves out of the consolidation. Okay, and the market structure and order flow shifts bearish here when we trade lower right there, because we broke that swing low. Now when this broke down, okay, we have to wait for another shift in market momentum. Okay, and this is the reason why I do not like this little fractal indicator. Okay, because remember I told you earlier that all I require is 3 bars or 3 candles to create a swing high. That's occurring right here. Notice there's an absence of a fractal arrow like it does here. That's because this big old candle here, okay, its high was above this candle's high, which would negate the formation of this arrow, or an arrow like this, a fractal up arrow, because the parameters require this candle to be a lower high than this one. But is this not a swing high? Yes, because it has a lower high on both sides of it. Okay, so this is a swing high. As soon as this candle broke here, we're back on the bullish momentum. Okay, and then we entered this range here. Okay, we started another series of days where those 2 moving averages have the 9 above the 18 moving average. So that we're in a bullish framework when the market structure is bullish. Okay, because again, we see this swing high here when it broke to the upside. Now we have to wait, okay, and expect to see the 9 be above the 18. Again, we're looking at a daily chart. During this time period, what you're going to be looking for is opportunities where price again finds support, pulls back within a range, okay, either on a 4-hour chart or a 1-hour chart. And when you see what we're going to be talking about later on in this video, what you're specifically looking for and hunting, 90% of the time it's there, and there's no reason for you to rush to chase price. If it doesn't do these types of things, you don't take a trade. Okay, what I do is I use the range of this low to this high. Again, this is a daily chart. Price comes right down into what level? The 79% retracement level. Look how many opportunities where price stayed within that optimal range, okay, and it rallied up. If you look at where we were in regards to that price movement, again using these bodies of the candles up to the high of this candle right here, that's 156 pips. Again, 156 pips within a few days. That's inside of 1 week's range. There should be no reason why you can't capture at least 50 pips out of that. Okay, the opportunity here. Okay, the bottom line is there's opportunity for you to make money and still quote unquote be wrong, because ultimately the market did move lower outside of this area here. Okay, and then we moved into a selling framework. Okay, you have the market break it down, making lower lows, okay, and lower highs. So we have the swing high here with a fractal. Now I got to change this fractal to a different color because it will not be seen against the red. So we have this fractal low here. Price breaks down through it, again confirming that we are in both concepts, agreeing with lower prices. We have the two moving averages. The 9 is going to be below the 18. Remember, when we marked out this box, that was giving you the bearish framework to expect lower prices. Momentum-wise, institutionally, they're going to be looking for order flows lower. Okay, and you see technically they are moving lower because we see the swing low here break down. Okay, so when you see that happen, what you're going to be doing is you're going to be looking for the ranges, okay, to form. You're going to be looking for rallies. You're going to sell into those rallies. See this low here, and we see the price actually move up here. This high down to that low, down to the 62% retracement level. Okay, and again, we're going to discuss a concept that is useful in terms of institutional order flow, where we can again identify areas on a lower time frame where this is again one more area where order flow and short-term market structure is shifting, and where institutional order blocks are retraded into to get another piece of the pie, if you will, before they start to move lower. You can see when the market moved up into that range, it did not spend a whole lot of time there, and that's why you had this very thin wick. Okay, the market opened here, rallied up, and then traded lower and closed lower, and that creates that black bar. Okay, the close is near the low of the day. You can see the close on this candle is 130.64 with the low at 130.47. Okay, as price moves lower, it breaks each new successive lower swing lows, and each swing high is lower as well. Now we have again an opportunity where the market creates a swing low here, trades lower, okay, and it comes back here and takes out this swing high. Okay, that's going to happen a few different times while we are in trending environments, because again they're going to come back and take the stops and search for liquidity. Whenever you see swing highs like this on a daily chart, naturally that's where support resistance is going to be implied by traders, and they're going to think that their stop loss orders are protected above that, and you'll see the market rally up there just above it, take it out, and then break lower. It still does not change the fact that we still are working within a range, okay, and that being this high to the low. And if you look it up in here, you'll see opportunities to be a seller on the lower time frame. Again, once we break lower here, we have everything in agreement as well. Okay, and I'm going to subscribe to the notion that you probably may have lost money here or missed opportunities. We're just going to call this a dead opportunity area where we didn't get any kind of reasonable positive equity increase. There was nothing that we profited from in here. Everything gets back in sync here when this candle breaks below this swing low here. Okay, and then we have the high here is penetrated here. So now on this candle, everything's bullish. Okay, inside of this overall sell framework. So what we'd be doing is what? We'd sit on our hands until when? Here. Okay, we expect what? See this low here? What is that? That is a swing low. Again, the fractal indicator arrow is useful to communicate general support, swing highs and lows. But again, this is the reason why I don't like it by itself, because it will avoid printing an arrow where I would classify that as a swing low. So when the market opened up down here, market structure and order flow has shifted to bearishness again. Okay, and this being the most recent swing high. As soon as this candle closes and this one opens up, this one would be a swing high to me. This is a swing low, and everything would be bearish here. Okay, and until that high is taken out on the upside, okay, or any newer swing high forming is taken out, I would be looking for lower prices. Okay, and the same thing happens here. We have the swing high because we have a candle with a lower high here and a lower high here. So this is a swing high to me. Okay, price breaks through it here. So now we have, on a very short term, market structure being bearish. Okay, I'm sorry, bullish. Again, inside of a bearish framework. So we're looking to do what? We're selling into rallies. We're selling into it. Okay, so this is where you're going to be applying what we commonly refer to as market flow or order flow. You will see on a daily chart many times rallies going against what would be considered market flow, like being bullish. In other words, we have this swing high here. It's a candle with two lower highs on either side of it. When this candle blew up through it, we would be considered bullish daily market flow or order flow. But you have that range here that you got to work within. Okay, and that looks like this. See how we went right up into that area here? both candles stopped dead on the 79-cent trace level, and then boom, it moved lower. Okay, and now we have everything back in sync again. We have this low taken out. We have both the framework on the moving averages suggesting lower prices, and the order flow and market flow is bearish because we took out the swing low, so everything's moving lower again. We'll be continually looking for selling opportunities, okay, inside this area here. Now again, we have the market creating a nice rally and reversal. Again, we are not trying to call the lows. We are not looking for the the tops and the bottoms of the marketplace. So even if we were to take a trade in here somewhere, okay, if something led to our analysis that we should suggest taking a short trade and we got stopped out, what do? We accept the loss and we move on. Okay, write in our journal, keep it as a learning process, and continuously looking for the next opportunity. All of this right here, okay, would be the same information just applied going forward. Now this, we only had these two examples in our analysis and study. Again, we had that red area and the two green areas. Inside of these pockets of price action, there's more than enough opportunities for you to take trades just using the daily chart. Okay, but if you use the 4-hour chart, you'll be able to glean a better understanding of what it is that you're going to be hunting. But before we do that, let's strip the chart again, and we're going to take these fractal things off here. Okay, and what I'm going to discuss now is what specifically is inside the candles that's useful to us, okay, and why consolidations breed opportunity. We have an area of consolidation right here, and I probably should take these rectangles off because there you go. And we have this consolidation right here. Okay, inside this, we're going to make it blue. In this little area here, okay, smart money is accumulating. Now, how do I know it's accumulating? Well, because number one, prices already moved off of an area where it caused a reaction. Okay, inside this reaction, this price move higher. Okay, we're talking about a daily chart moving for days to the tune of about 465 pips. Okay, retail traders can't do that. So institutional funds and institutional traders will. Smart money will. This is the elephant putting its foot in the water. Okay, and then we go into a consolidation. It's pausing. In here, traders chase it, thinking, okay, what's been going up? I'm going to keep buying it, and they get pounded here, they get pounded here, they get pounded here. And at this point, they say, well, it's probably not going to keep going up, so I'm going to be a seller. And what do? They sell a breakout, okay, or they sell, whatever pattern they think is beneficial to them, and end up getting caught on the other side of the market again. We as traders, okay, here's what we're going to take a huge step right now, okay? You need institutional sponsorship in your trades. Institutional sponsorship is when you start seeing things like this. This market moves up, moved into consolidation. This is where pairing of orders is taking place, okay? Institutional trading is building up positions all in these areas here, okay? And what you're looking for is where areas of where the market has moved with a great level of conviction, okay? If they can move the market almost 500 pips here and it starts pausing, chances are it's probably going to be another leg up. And what do I mean by that? Well, if you take this low to the high in here, if you see that range here, it's probably going to look to make a move equal to that same thing. Okay, and here's a low. We're going to basically use this because usually the same, this here and here is basically the same price. And if you take this out in time, you can see the market did move in fact to that same price level. Again, it's just like a measured move, taking the first swing and then consolidation and expecting another move higher. What I want to draw your attention to is, again, on the daily chart, how I like to view the market is, see this candle here? Okay, if we look at that, this candle right here, the body of that candle, okay, is to me the most useful portion of it. Okay, when price rallied up, okay, and consolidated and moved out of it and came right back down into it, but was unable to break this low, we are in a consolidation. Okay, in this area in here, okay, something's going on institutionally speaking. I don't know exactly what it is, but I know that there's something that traders on a large institutional basis want this price for whatever reason. They think there's value to it. Okay, And what we're going to do is we're going to be looking at this whole area here, and I really should be using the high of the candle, not just the body, but this whole area here is important because this is going to be an institutional order block. Okay, when price rallied out of that and came back one more time, okay, they dipped it below this area here to clear out any kind of stops that would be resting there. Okay, and it's a stop run. One of the most important things you can have in your notes is if the price can come back to a key level support resistance, sweep through it one more time, okay, and then fail to keep going, that's generally a sign that it was a stop rate and they're going to ready to do a major repricing going the opposite direction. In other words, contrary to the direction the stop was ran on. So in other words, they drove it lower here, engineered it lower to send it higher. Okay, why did they do that? Because they want the orders that are in existence down here. Okay, so what do I mean by that? Well, we had one little order block in here between this candle's high and this candle's low. Okay, when price rallied out, they couldn't get all their trade on. So what do? They stopped their buying. Okay, and with their not buying, price will be permitted to trade lower, and then they'll support the market again. Because why? Their buying comes back into the marketplace in here. Okay, and they're buying it up again. That's going to control this decline and keep it from going back into this area here because they already have established positions back here. They don't want those violated. They don't want to see a net loss in there. So they're going to add more positions in here, supporting the market. Again, don't think like a retail trader. Think like the banks, the institutional guys. They want to keep this thing. They have a vested interest in keeping this market up. So if they want it to move higher, they're going to be buying it at a level where they consider it valuable, okay, or a viewing perspective on the marketplace as it has a worth of some sort, or undervalued, if you will. Now, as price moved out of this area here, again, this is that consolidation area we just had blocked off. As price moved out of that area here, we have market structure shift here again to bullishness. So this high was taken out here. So let's draw that out. Okay, we have our bullish market structure here. Price rallies up again, and then we have this decline. Okay, now remember earlier I was discussing that this, yes, it was 3 days where it was bearish. I'm not ignoring that. Okay, the reason why I was going to come back to this example here, because this is exactly what I use to get into these types of trades. If you look at this area of where the institutional order block was, okay, and again, how am I defining that? Because we went into a consolidation, we rallied up, okay, and you want to see a conviction, a very strong conviction in the marketplace. And when you see something like this where it moves several hundred pips, retail traders can't do that. So that's the elephant putting his foot in the water. And when the price comes back down, okay, and it gets back in the same area, we can reasonably expect to see it to do what? We expect it to rally. And when it rallies up and breaks these highs, we know that they are really putting an effort to keep this thing going, moving higher. Now watch, we're getting ready to take a huge leap forward, okay? This area here, because we used this first candle, it's the bearish candle, okay, prior to the first rally. If we took this down to a lower time frame, what do you think this is going to be? There's going to be a market structure or a market flow or order flow reference point where if it breaks to the higher side, we would expect to see what? Bullish prices, okay? But also, it's during down candles, okay, or down moves is when the smart money accumulates positions. Let me say that one more time because it went right over your head, I'm sure. Smart money or professional traders do their buying on down moves. They do not chase price. They buy it when it's going down, okay? When the market strong arms or smart money traders want to sell, they sell when the market's rallying up. They don't sell it when it's dropping down, okay? So have that in your little notebook. You want to be doing the same thing, which is one of the strongest components that makes up my trading because I'm a buyer when the market's moving lower. If you were watching this series of 2 days here on an intraday basis, this probably looked like this was like a bat out of hell, okay, screaming lower, and it's probably going to keep on trading lower and lower and lower. You have to understand on this higher time frame daily chart what was taking place. See this whole area here we just blocked out? We have 2 areas of where they have created 2 large institutional order blocks. I'm going to show you the second one that took place. See the rally it took off here? The bearish candle right before it taking off is where you would have your expectancy of market structure shifting on the bullish side right in here. Okay. Now as price rallies off this low here, okay, and again, I think this is a consolidation in here. So with this consolidation, there's opportunity being bred, okay, and as the market moves higher, okay, it moves up in a rally, and again, you can day trade in these moves following that because this is a daily chart. So moving within this price swing, we can reasonably expect, intraday trading opportunities, which is beyond the scope of this teaching again. But as price moves up and makes this price swing here, starts to retrace back in, we have 2 order block areas that may be utilized as retracement opportunities. Okay, you have this one here with this candle here, which is the first down candle prior to the rally up in here. Okay, so above this high here would be the indication of a market structure shift on a lower time frame. So when it breaks above that, if it comes back down to that same point of origin, this will be a likely candidate for a buy. Now, what I want to draw your attention to here is the fact that we didn't get lower than these lows here really doesn't negate the validity of this potential area. It just means that they had enough of their orders established in this area here on this prior to this candle making this here. In other words, this down move here, all these candles moving up, breaking the swing high here. Okay, this is the first down candle. The high above this candle here, when it broke here, market structure on the lower time frames was bullish. Okay, so when we see that, price comes right back down, dips into the same order block here. Now it went a little bit lower again, but if we extend this in time, I'm going to illustrate what it is specifically that's going on an institutional level that you need to be aware of to help you with your trading. And I'm going to take these lines off because they no longer are serving a purpose. Okay, so price comes down. And again, remember these days here we were talking about earlier. If as price ran up here, we were in that bullish environment where the averages were indicating that we were likely to see upward pressure. When price came down like this, we can sit back and wait for price to enter back into an area of potential institutional order. So when we have price moving back into that, this is where we start understanding the mechanics behind the ICT optimal trade entry pattern. And let's take a look at that now. We have the swing here from this low up to this range high here. Okay, so we have the low here and the high here. Price comes down and slams right into that 70.5 level, or sweet spot, like I like to call it. That means you could be buying anywhere around that 130 big figure, not factoring in the spread, obviously. About 3 pips is a safe bet. In this case, 130.06 or 130.05, that's a good number to try to get long in. The low prior to that, this swing low here, would be a possible scenario too. Had you were expecting this candle here, if it dipped down lower, we could have caught to 62% there. Okay, so I get a lot of questions on why I move my fib to certain swings and such, and now you're understanding really the mechanics behind it all. So let's look at the optimal trade entry a little bit closer and understand some central tenets to it and what's specifically the pattern really capitalizes on. When we have a market take out a swing high like this, okay, we have institutional sponsorship that takes the market above, okay, and when it returns back into an area of previous consolidation, we expect that to reposition or assume more longs. Okay, so in other words, they're pairing orders in here, they're allowing the market participants, okay, to see this quick drop down. Okay, and that's one of the things I find kind of interesting. When the markets are predisposed to go higher, they have these really 1 or 2 quick down dynamic days. Okay, and it kind of gets you all flustered and thinking, hey, look, this market's probably going to go lower. And if you're really sensitive to the lower time frames, like 1, 5, 15 minute, and even less than hourly in any capacity, it's very easy to swing your daily bias based on that. And if you learn to start looking at these daily and 4-hour charts, it helps you hold on to a longer term perspective, and you're less likely to be lulled into swinging back and forth on a daily basis. Your daily basis being bullish one day and bearish the next. You can see really when these moves really take off, there are several days that they move. Okay, then you have a retrace, and then there's several days where it moves, then you retrace, then there's really dynamic, several dynamic days on the upside once it really starts to move out. When you find that it's fulfilled its order block, okay, you'll see that there's many times very little time for you to catch the entry point. So you got to know these things in advance, and that's why reacting to a price is not really the best case scenario. But as price moved down into this range here, okay, you can actually see in this smaller consolidation, okay, see this right here, this little area right here. Let's use this rectangle to highlight that. And what we'll do is we'll actually go down into a smaller time frame 4-hour chart, and we'll study that little consolidation as well. So we're going to assume for a moment that you were not privy to knowing this order block or institutional order area here. Okay, and as we moved into a consolidation in here, okay, what we'll do is we're going to drop down into a 4-hour. Okay, and you're going to see that same underlying pattern. We have a swing high in here, which is broken. Okay, I'm going to recap the pattern what you're looking for. This is how institutional trading can be mimicked. Okay, you have an area of potential support, which we've already identified on the daily chart. Market ran up, made a swing high, came back and retraced. Now, you can trade this with the pure understanding that's a support level, and this could be your retracement here. Okay, now again, that's a 4-hour basis. You could do that, and the reason why is because you're using the same underlying premise that prior to this move up, the first down candle prior to it, which is here, if price returns back to that range, as it does here, okay, and I'll drop a fib on that so you can see the mechanics behind it. Okay, you can see the 79% retracement level stops at dead to rights, boom, right there. Okay, and then price rallies up. In here, when we have this break here on a 4-hour, this is much more dynamic. When you see this take place, okay, put this in your notepad. If you see the overall pattern on a 4-hour chart break like this, and you're overall bullish still on the higher time frame daily, man, get ready, because it's going to have a dynamic price surge higher once we have a return back to the point of origin. The point of origin is what we discussed right here, and then when price moved up here, again, the first candle that's down prior to the rally up, once price rallies up away and breaks the swing high like we just discussed, right here, we have this rally up, we wait, and when price returns back to this point of origin right in here, okay, this is where they dip back into that order block. Okay, so they had their orders here, they came back, they want to get an average fill around here, that 130.20, maybe 130.30 level. If you look over here, you can see that's the case. Price comes down, dips back into that order block again. Okay, they spend about a day or so in there acquiring more long positions. Okay, now what we'll do is we're going to use this swing low here up to the high here, okay, using that same range, and you can see the 79% retracement level right in here is containing the bodies of the candle, and there's only been 2 little wicks. Okay, we're talking about maybe 3 pips that it violated the 79% retracement level. So if you were using just a 10 pip stop below this low here, and I don't want to get into stop loss placement yet, but I just want to give you a little hint as to what's going on. If you're buying in here at the 79% retracement level, and we'll just be fair and say you're buying at the 70 and 70.5, at the low here's 37 pips, and your stop to be 10 pips below that would be at 130.04. Okay, and that means you'd be risking, if you were trading just on the 4-hour basis, you'd have to have a stop of 47 pips. And that's still very close to what my average standard 30 pip stop loss is. So you can see how, by understanding this, we've already trimmed down a huge amount of the risk on a 4-hour time frame. Not to mention what we could do if we drop down to an hourly basis and or 15-minute basis, which we'll do in a few moments. But just for the moment, let's just look at this again in greater detail. Price moves down into this order block based on this candle here. You see it does not really jab down here and stab very aggressively. It just holds the 79% retracement level as we just noted earlier. So once price does this and it accumulates whatever it is that institutional traders are trying to acquire, I don't have the insight as to what it is specifically they're trying to acquire, how much of the position they're assuming. I just understand the footprint that they leave in the marketplace. So when that takes place, okay, we know that it's most likely going to have an aggressive move up, okay, because we had the first run up here and then a 4-hour market structure break here, and then you wait for it to come back. Where's it going to come back to? This is your point of origin right here, okay? And it could very well easily come back into this one as well and create more or less like a double bottom. It rarely does that, and the reason why is because once it goes down, it doesn't want to usually come down much lower than that, because other institutional traders may get on board and drop much lower than that and throw off their targeted average entry price. So as they move up here, you can see, you literally can see it. There's a buying opportunity here. They acquire. Okay, it starts to move too much, so they settle down, relax, let price come back down again, dips back into this little area here. Okay, they buy more of it, and it rallies up. You can see there's much more aggressive buying pressure on this candle here, because it took 3 4-hour candles to make this range here, and then 1 4-hour basis, boom, they took it up here, then come back, retrace. Where's it retracing to? Point of origin right here, and then all of a sudden the remaining block of trades that they want to assume for a long position was acquired here, and then they're off to the races. Now, just trading back to an old high like this, let's note that, and you can see, okay, looking for upward targets as like that, we're going to use this one first as an objective, as an example. There's 270 pips below your feet, and this one here, again, we're going to assume you traded at around the sweet spot. And again, there's 240 pips. So you're really would you be willing to risk roughly 50 pips, just trading on a 4-hour basis, risk 50 pips to make 240 pips? Does that sound like a good reward to risk? I'll leave that up for you to decide. But as price moved up, you can see it quite easily hit this objective and it moved on beyond that as well. So with this example here, you can see how just simply waiting for these scenarios to set up, you can trade really a good number of pairs if you're trading on a higher time frame basis like that. Because number one, think about how much time it takes to set these trades up. It takes a good bit of time. Also, it gives you an area where to anticipate and hunt these specific patterns. Okay, so it allows you the freedom to sit on your hands and wait and not feel rushed to get in there and just take a trade simply because it's something to do. So now what we're going to do is we're going to actually drill in tighter. Okay, and what I'm doing is I'm actually moving into this little pocket of price action. Okay, so this fractal here, we're going to look at in regards to a 15-minute. Let's go down to a 1-hour basis and see what that does first. Okay, now you can see price rallies up out of here, and right in here you can actually see how we're actually starting to fine-tune. Here's the bearish candle, the first one right before you go to the move up. So if you bracket that out, okay, you can see that's the order block in here. Now again, it's anywhere in here specifically, okay, but what I like to see is like a Fibonacci level and or pivot level in this area to suggest where price may be going. Also, I like round numbers, and in this case the 130.40 level is really ideal, and you can see that's also roughly the same price point this swing high is. Now also remember what we talked about when we look at swing highs, we like to look at the 3-bar pattern. Okay, here's the highest candle in this pattern. The right candle to the right of it with the lower high, its open and close and high and low is important. The open, high, low, and close on the high candle, or the highest most of the 3-bar pattern on the swing high pattern, and then this high here, the open, high, low, and close as well. So when we factor those individual price levels, you can actually take that out and extend it across in terms of like a horizontal lines, and really specifically wait for price to move down to those levels on a 5-minute or 15-minute basis, and really fine-tune your entry in regards to what may be possible for trimming down the stop loss orders. So now what we're going to do is we're going to take the same price level here, okay, and I'm going to look at this small little section in price right here, and I'll make sure I'm not getting more than I want. Okay, right in here's what I'm looking for. Right there. And again, that's January 9th. And we're going to drop down to a 15-minute time frame. Okay, and now watch. We have price action, okay, in here moving up on a very short-term basis, okay, and comes back down. See this candle here? That's your point of origin, where the rally ensues. Right in here. You move that out in time. Right in here, price comes back down into it, and then runs up, okay? Same thing here. Okay, we have this rally here. Here's the candle prior to the rally up. It's bearish. And if you take that area here, you can see it enters that order block again. Right here. And again, if you run your fibs on that, okay, you can get opportunities where you can take intraday trades and get in sync with the higher time frame trades as well. But assuming that you took that as your entry point based on the higher time frame trade, okay, you could trade this here, okay, maybe get in at 130. Let's see what is that price is, 130.45. Let's say 130.47 is fair, and you're using a 10 pip stop below here. Actually gotta crunch this up just a little bit so you can see where the stop loss would be, and you can trim back the risk. Again, assuming you're getting long on a limit at 130.47, and we're going to use this low here as your primary reference point for stop location. If you go down 10 pips below that, your stop loss order will be at 130.27. Okay, and what we'll do is we're going to put that in here, 130.27, and price comes down, but never comes close to it. Okay, let me scrunch it out, you can see it. So you can get yourself positioned here. Okay, and again, this is a 15-minute chart, so you're waiting for these positions to unwind. Because remember, we're looking at a 4-hour and daily time frame setup, so you're not trading it on a 15-minute basis. So when you start seeing these wiggles lower, where's your stop loss? Down here. So you just simply let it do its thing, and price rallies on up, and you get excited, and everything's, you know, as you'd hoped it would be. Okay, you can see the point of entry back here, and then the ultimate unwinding of that position here. All right, let's take a look at another example, and we see this price rally up off of the daily chart, key support level down here. And what I draw your attention to in here is obviously this quick rally up and then a bull flag formation in here. We have this level in here. If you were following any of my market reviews, we talked about this level being a possible area of support. And prior to the move out, okay, we had a couple different areas that could have lent to probable areas of support and institutional dealing ranges where order blocks may reside for the institutional level trading. And that comes in the form here. We have this candle here prior to it to move up. Okay, in other words, this move higher, and this candle here. Okay, and you can see that's the first bearish candle prior to the move higher, first bearish candle prior to the move higher, and we see also, just likely support and resistance level based on this intermediate-term high on the daily chart. We did get an opportunity to see it bounce here, okay, and that's seen with this move here. This was the bearish candle prior to its rally up. So if you take the range in here, you can see how this retracement would have been a very decent, handsome opportunity to get along on. Price came back down to that same institutional order block here and rally up higher, and eventually started to break down. Okay, and let's take a look at what transpired here. We lost this level here. We started trading lower. Okay, and this would be the next area to expect some support. Okay, and you can see price trades right down into that right there. Okay, now what I'm going to do is I'm just going to take a horizontal level, draw it across the chart like that. Okay, and when you see this is an area where to reasonably expect prices to bounce. If you notice also the low here to this high, this is your price swing. You see that? Okay, we're retracing inside that price swing. So if you take the range and highlight that with your Fibonacci tool, you can see the sweet spot lays directly right on top of that same point of origin right in here. Price does not move much lower than that. Again, this is a daily chart, and price rallies on up. And price rallies on up. Okay, so you can see that there's a definite advantage in knowing where the institutional level trading is going to come in to the marketplace, and by having an understanding of where that's going to take place, you can also expect it on a time basis with the kill zones. Okay, so we have an understanding of support resistance, we have an understanding of the time of day, we understand where the big moves should ensue, and where to more or less wait for them to take place and form based on the higher time frame charts. If we look at the market on a shorter time frame, okay, and we're going to apply our tools we learned for the directional bias. Okay, and the 18 period. Okay, and what we're going to do is we're going to look at a time frame when price was moving up in here. Okay, and I'm going to highlight that with a little rectangle in here, and what that's going to help me do is show you how to use this for trade entry. And what we're going to do is we're going to break down to a 15-minute time frame to do that. Okay, what I did was zoom down into a 15-minute time frame, and I added the Asian range for each daily intraday action. And
what I'm going to draw your attention to here is, as market moves into, this is a Monday, okay, it's very hard to see here, but this is a double line delineating a Sunday. Okay, I'm just going to scroll through, and here is a Monday, and going into Tuesday. Here's Tuesday's trading here. Okay, now looking at this, you can see how price moved up here and created a range here. See this down candle prior to the move up? Okay, we had this rally up here. If you take your fib and you pull it from a swing low here up to this range high, price comes down to the 62% retracement level, and this is 9 GMT. This is the London Open. Okay, so there's an opportunity where being long. Okay, and now with the background being blue like this, again, what that's highlighting is a time period when on the daily basis we have a 9-period exponential moving average above the 18-period. So we have institutional momentum on the upward side of the market. In other words, we're looking for just buys. The framework is established as a bullish scenario. So we would be looking for opportunities to be a buyer here. And that's one example here, using what we just discussed with point of origin here, and when price rallies up and trades back down into it, we see price move up into its high for the day. And now we have another right here. Okay, we have this range here, and it trades down. We're going to use, this is the first down bearish candle prior to the move higher, so we're going to use that as its basis. Okay, right in here, and we have this candle here prior to this move up, so we could use that one as well. And what you're looking for is clear points of where price moves with conviction, okay, where it's really clearly trying to move away. You have it here, okay, and then you have it here. Again, it's the 15-minute time frame, and then price makes its price swing and trades lower. This candle on the very low here is 15:15 GMT, so that's like 15 minutes past the kill zone that was established for this trading series. This here is 15 GMT, and this is 14:45 GMT. So this is still a capable trade setup for the New York Open session. Late for New York, but still nonetheless, it's something you can take a trade on. Let's go out one here. We have just in market structure alone here. This is nice, where you have a low, a lower low, two of them in here, and then a higher low here. So we have an intermediate term low just in market structure alone. So that's bullish by itself without anything else added to it. That's very good. Then we have price rally up away here. This is our first bullish candle prior to the move up. Okay, you can see how it rallies up. This is your range. Put your fib on that range. Right in here. This candle here comes in at 9 GMT. This candle here is 9:30 GMT. That's London Open. Okay. We also have this rally here, and then it comes right back into, here's the first bearish candle prior to the move up. So this is where the market structure would shift. Okay, and without having to draw a line, you can see we move back into that range right here. Here is the smaller reference point. Here's where you would be buying, and again, 10 pip risk below here. Let's give you an idea what that will look like in terms of, again, we're going to say we bought at the 70.5 level at 131.07. Here's the low, and if we go down 10 pips below that, your stop would be at 130.86. Okay, so approximately a 30 pip stop, well within the range of probable. And trading back to an old high, you can take profits here, or just look for it to continue moving on a higher basis. Okay, you can see price moving up here. Now, just let's zoom in here, and I want you to see, using the ideas that we just covered. Okay, look at every time when the market moves up, breaks a swing high, okay, then comes back down and comes right back into that previous
point of origin. In other words, this is where the move starts and trades right back into it. This is what you pull your fib on. Okay, I get a lot of questions. You know, what am I looking for? Why do I put my fib where? Why would I use those reference points like you do in your videos? Well, if you go back over all of the videos you ever see me doing it, you'll see me doing this very thing. Okay, and here you go. We have price moving up here. Okay, this is a Monday's trading. We have the first bearish candle prior to the move going up. Okay, take your range, draw it out over here. Okay, when you see that here, this candle forms at 6:30 GMT. Okay, 6:30 GMT. That's about a half an hour right before the very beginning of what I like to see in terms of the meat of London starting. You can see how it comes right down to that sweet spot in here. Okay, and also note, and I probably should have said this, I'm jumping ahead of myself. When you're looking to be a buyer, you want to be doing what we mentioned earlier in the previous video, using the Asian range high as your filters. In other words, you want to be buying definitely anything below this level. Okay, it's an ideal position entry point. Again, here we have the Asian range high. This is below the Asian range low, so that's even better. Okay, and here is the New York session buy, and again, here's the bearish candle prior to the move up. Okay, and if you look over here, you can see we move right back into that point of origin. Okay, so they moved right back into that dealing range and order block. And if you use the low in here up to here, you can see how we went right down to the 79 saturation level and moved up rather handsomely. Even if you used the low formed in London, you're still getting almost a sweet spot here, but certainly this 62% retracement level, and getting in sync with the daily trend. You can see how that's rather handsome in terms of a trade opportunity. Okay, and again, we have this point here where we have a New York session low. Remember, we're looking at session highs and lows, not just previous day's highs and lows. And here is your bearish candle prior to the rally up. So you're going to see market structure shift on this candle. Draw that out in time. Okay, because this is the point of origin where this rally took place. So the range that was created here originated right here on this bearish candle. So when the market structure broke here, this is where the order block resides. Okay, within this candle, this is where the institutional order block resides. Okay, so when market meanders and trades lower, where does it go back into? That same order block, and then they acquire more of the original position they were trying to acquire here that they couldn't get on because the market started to take off. And if you take that and you add that to your fib, okay, you can see how here's the 79 saturation level, deviated just a little bit, and we're going to give you actually how much it moved below it, to give you an idea how much. And we're talking about 6 pips, and I think that's livable, guys. You guys can certainly tolerate that. If you were to use the lower low here, you still end up with the sweet spot. Okay, so you can see how using session lows and highs, with a directional bias defined as we just covered in this video, it really helps you ferret out opportunities, and certainly being a buyer down here below the Asia range high. Okay, think of the daily range. Remember, we were talking about the likelihood of big range days. If we have the opening price in here, okay, it doesn't really work both sides of the opening price very much, and certainly doesn't work the lower end making the low very much. In other words, what do I mean by that? There's not much range on the daily bar from the opening to the low. Okay, and let's see what that does here. Okay, we're just going to eyeball it, and we're talking about 27 pips. Okay, 27 pips. So it worked lower 27, but moved off of the lows for the day to the tune of 76 pips. So it's basically 3 to 1 almost. Okay. The reoccurring principle is simply looking for retracements in an uptrend. Okay, so you're buying dips in an uptrend, and if you look at here we go here. Here's one where it was not able to get down into that price point in here, but using just the optimal trade entry, you can see how we got a sweet spot here. Okay, the ICT optimal trade entry pattern. The premise really builds upon the understanding of support and resistance, and we're going to use this example here to illustrate the example of an optimal trade entry that's used for a buy entry. And assuming that a support level has been arrived at, we have this support level, which is ideally a higher level daily 4-hour or 1-hour time frame support line. This high here, okay, this swing high breaking this previous high is good. That's what you want to see. Okay, and then when you have price break it again here, you have another more or less a conviction by the traders that are in control of price, which are smart money. They are indicating to us that they are wanting to see this market not trade lower. Okay, so if it's not going to go lower, chances are it's probably going to go up, and go up sharply. Now, if we see the star here that's delineating a break in market structure, okay, on both points, the previous little short-term high that we just showed, and now when the price ran up aggressively through that, what we would be waiting for is price to return back to the point of origin. That's seen here, where price comes right back down into the first bearish candle prior to the rally up, okay, breaking market structure here. So now we have a range from here to here, okay. So we're looking for price really to stay above support, not necessarily trading back down to that same price level. This is the swing that you should be identifying with your eye. This is what you train your eye to see. This particular price swing is what's necessary for you to pull your fib on. By doing that, and again noting where the market structure has shifted, when price moves back down into this area here, it's between the 62 and 79% retracement level. The 70.5 level is what I deem the sweet spot. That's generally what I try to aim at for my entry point. I may add the pip spread from that point, or I'll use the 62% retracement level, depending upon the type of pip range between the two. If it's not a whole lot, you know, I'll just simply use the 62, so just to make sure I get the trade, as long as it doesn't deviate my overall price parameters in terms of allowing my stop loss order to be within my maximum risk per trade. And obviously you can see the results of taking this type of pattern with the understanding of everything that we've talked about in this video series up to this point. In that little in that little green box, ideally that should be a kill zone, be it the London Open or the New York Session Open. Okay, those are the ideal trading scenarios for you to be finding trading opportunities to get long in, and again with the assumption that the 9-day exponential moving average is above the 18-day, and when you have that, and also order flow and market flow and market structure on that time frame, daily and 4-hour, are suggesting higher prices, it's all but a green light just to get in there and start hunting buying opportunities using this format.